Let's sink bonds. This is rising energy costs and the prospect of more stimulus raise the specter of accelerating inflation, but so far it's just a specter. WTI hovers at $60 a barrel as freezing temperatures and a power crisis take out around a third of U.S. crude production, and lockdowns hit luxury. Gucci sales dropped 10%, ending years of growth amid renewed restrictions across Europe. Let's take a look at futures very quickly. A little bit of a mixed picture. Most of the morning, we had FTSE futures gaining while continental futures were down. You can see that British futures are also now in the red, although just fractionally. The moves down in DAX and CAC futures are getting bigger as we get closer to the open. Here it is, Global Macro Movers screen on your Bloomberg, GMM Go. You can see each one of these columns has a different asset class, the far left-hand column being the equity indexes, and it will populate as they open. The FTSE always the first out of the gate, and it is very little changed, although you do have a green arrow there as opposed to the red arrow in Madrid on Spain's IBEX, right now down about 0.3% as the FTSE holds its gains, just up about 0.1%. So it looks like we could see a situation where continental equity indexes are down as the FTSE rises a little bit. With the pound off, that makes a little bit of sense, although the pound is still at a relatively high level right now, 138.82. As we wait for the next to open up, typically the CAC 40 in Paris, we see the AEX open up in Amsterdam, and then usually the DAX is last. Here's the FTSE MIB open, down 0.2% in Milan, but also not a lot of size. You know, if these blocks are gray, that means you're not seeing a huge move away from zero. Red obviously indicates a bigger down move, and green a bigger up move. But we are seeing European markets, the continental equity indexes open up down as the FTSE remains little changed in London. The buy everything but bonds rally is taking really a pause, I guess. Treasury yields holding near a one-year high. Joining us to talk about this is Bob Parker from Quilvest Wealth Management, where he is an investment committee member. Bob, thanks for your time this morning. It does look like we're taking a bit of a breather with the so-called everything rally. And it's very interesting to see yields, U.S. 10-year yields, jump so quickly, now trading at 1.31%. What do you make of this?
Well, I think it's inevitable that after the big gains that we've had year to date, and really across the board, with particularly the gains in Asia that we've seen outperforming both Europe and the States, but it's inevitable that I think we go through, a few weeks of a pause. And obviously one factor which you mentioned is the rise in 10-year US Treasury yields. And, we've now broken through 130 basis points. And, we've seen similar moves elsewhere. So this isn't just a US Treasury event. If we look at, for example, 10-year bonds, the yields have come in to minus 34 basis points, and also a big move in JGBs. And JGBs have been anchored for years at zero, and we've now jumped nearly 10 basis points. So I think an increase in volatility in the bond market in turn leads to a consolidation in equity markets. Now, are we going to have a major correction in equity markets? I think the answer to that is no, but certainly a consolidation for a week or two is likely.
Why won't we have a correction? I mean, you don't see the big valuations here that you do over in the U.S., but you're starting to see frothiness. You're starting to see bubbles. I mean, we've been saying this for weeks, if not months. Aren't there places where assets are overvalued?
The answer is there are lots of places where valuations are extremely stretched. And it's an interesting question as to how you define a bubble. And, my definition is obviously stretched valuations relative to history, concentration of investor positions. And, we've clearly seen that in sectors such as the tech sector, not just in the States, but in Asia and to some extent in Europe. And, as you were talking about earlier in the program, the use of leverage. And, clearly in the US, retail investor space, there has been an increased use of leverage through derivatives such as the options markets. I think it's interesting that institutional investors seem to be very under-leveraged. So, yes, we've got sectors which are looking very stretched, and one really has to question to what extent those valuations where price-earnings ratios are sort of well above 30, whether that can be maintained. But overall, the outlook for the second quarter is one of a growth rebound in the States and Europe, corporate earnings growth recovering, particularly in Europe. And I think one interesting question at the moment is whether markets are fully discounting. We talk about the reflation trade. I actually call it the growth rebound trade. And if we look at sectors such as industrials and materials, they're still, frankly, reasonably priced.
One of the things, speaking of a rebound, we've had seen so much savings, and you'd expect people to go out and spend them as quickly as possible. I'm looking at Kering shares right now. We were talking earlier about the Gucci story, and I can understand why you never want to wear white socks with loafers, right, Bob? I mean, who's going to do that, especially if you're wearing shorts? You don't wear white tube socks with loafers, but it looks like Gucci's trying to sell that and not doing very well with it. Kering is down 7.5%. What's your view on the luxury market? I mean, this may be a problem specific to Kering and not the overall industry, but what is your view on luxury goods right now?
Well, it's interesting that, we've seen a recovery in demand for luxury goods in the Chinese and other Asian markets. So, those luxury brands which are more focused on the States and Europe, I think, have underperformed relative to those which are focused particularly on the Chinese market. You're quite right in saying that what we've seen over the last year is a big jump in consumer savings. And if you look at the savings ratio in the States and really across most European economies, savings are well above 10%, whereas historic norms are sort of plus or minus 5%. So there is this pent-up consumer demand that, to some extent, is actually reflected in the high price valuations which we were talking about earlier on in the consumer discretionary sector. That's much more pronounced in the States and certain markets like China. Consumer discretionary in the luxury goods sector in Europe, in fact, is not looking particularly stretched at the moment. So I do think that as we go into the second quarter and for the rest of this year, we'll probably see a recovery in the luxury goods markets.
All right, we're gonna take a break, Bob, but we come back, I'm gonna ask you about other things to do with that money you've set aside. Personally, I just want to buy, I'm going to say internal combustion engine driven vehicles. And yesterday I talked with a guy who sells a lot of cars in the U.S. They're doing quite well. Bob Parker, Quilvest Wealth Management Investment Committee member, is still with us. We're going to keep him for a little bit longer. We're also going to talk about, the gas that you put into those vehicles. Those prices may go up because freezing temperatures and a power crisis in Texas have taken out a third of U.S. crude production. We've already seen the price per barrel rise. It may rise at the pump as well. And of course, that hurts a lot more over here than it does over there. This is Bloomberg.
To not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
It is simply unacceptable at this point for people to be without power.
One of the problems is that our system is an isolated system.
We're going to have to take a stronger look at who's allowed priority on our grid system. Right now, we're saying that the renewable energy has that priority, which is discouraging our reliable energy source, which seems to be more natural gas, fossil fuel related.
This is a timely reminder for a wake-up call, really, and saying that, yeah, we absolutely need fossil fuel in the mix.
It's a temporary thing, and hopefully they'll get things back to normal soon. But it did disrupt, the oil market, especially in that region.
Reaction there to the ongoing cold snap and energy crisis in the U.S. That deep freeze could persist for several days, with total U.S. oil production plunging by a third, the biggest drop on record. Bob Parker from Quilvest Wealth Management is still with us. Bob, how do you think this comes through in pricing? Because we saw NYMEX crude rise to $60 a barrel, but it flatlined from there. It doesn't seem like prices are getting out of control, and it doesn't look like they're necessarily going to hit the pump that hard.
Well, I think over the last year, let's not forget that, last April, we had WTI in negative territory. We had Brent down at 20. Brent is now trading at 65. So I think the first observation to make is that as we go into April, probably we are going to see a base effect with that impact on inflation. So headline inflation due to the rise in commodity prices, not just oil, but other commodities as well. We're going to see that move. So prices at the pump probably will move up over the next 2 to 3 months. In terms of the outlook for the oil price, we've obviously had a very big move. I think it's reasonable to assume, coming back to what we were discussing earlier, that with an increase in demand and activity in the global economy as we go into the second quarter, the demand will keep prices high. So I think it's perfectly reasonable, even with OPEC Plus increasing production in April, that we will see Brent trading between 60 and 70, at least for the next 3 to 4 months. And if anything, I think the risks are skewed to the upside, with potentially Brent moving up to $70 a barrel.
Yes, speaking of increased activity, I spoke with Mike Jackson yesterday, the CEO of AutoNation, which is, I think it's the biggest, private dealer of new and used cars in America. They are selling a ton of vehicles because people don't want to ride the subway, sit in the bus, even fly there. They want to drive in their own car now. Do you think, peak car was supposed to be 2019, and it looks like we could still be headed there. What do you think about car sales?
I think so. Number of themes. I think the first theme is, first of all, sort of a switch from air travel plus public transport to private transport clearly is going to boost demand for the auto sector. I think the other theme, which we're seeing very much in Europe, which is the move, and actually to some extent in the States, which is the move out of city centres, whether it be into living in the countryside, working from home, that all supports also demand for autos. So I think all those factors are supportive. Within that, obviously, we saw it from Jaguar Land Rover this week. Clearly, most of the major manufacturers are now really accelerating their move into hybrid and electric production. I thought the announcement from Jaguar Land Rover was very significant indeed.
Yeah, well, on that note, going the other direction, Land Rover is now offering a limited edition trophy truck version of the classic Defender with a V8 engine. I was thinking about pre-ordering one for Guy Johnson, but I think they go for like 250,000 pounds. Bob, I look at the valuations for these car makers, and frankly, I'm quite impressed at the levels. I use the RV screen, the relative valuation screen on the Bloomberg, and I'm looking at, for some of them, BMW is trading at 13 times earnings. That's pretty strong. Stellantis is trading at 13 times earnings. That's pretty strong. Stellantis is trading for 13 times earnings. Volkswagen is trading for 20 times earnings. I guess people are starting to give them credit for Porsche and Lamborghini. Are they overvalued here? Have investors bought too much into these car makers?
I think for what I would call sort of the mainline car makers, whether it be Daimler or BMW, or for that matter, Jaguar Land Rover, I think actually the valuations, we're probably going to see an increase in valuations in the next 2 to 3 months. And I think so one theme is actually, I think this is going to be a very interesting investor theme for the rest of this year, which is that, let's call them old-style companies, whether they be the auto companies or whether they be the oil companies. But those companies, for very good reasons, are undervalued relative to the overvalued sectors such as clean energy and tech. But as those old-style companies switch more into electric or clean energy production, I think you're going to see an adjustment in their valuation. So I think we actually have quite an interesting anomaly here.
All right, I'll be on the lookout for the all-electric Range Rover. Can't wait to see them unveiling that new design coming, I believe, at the end of this year. Bob Parker, Quilvest Wealth Management Investment Committee member. Always great to have a conversation with you. And I'll tell our radio listeners they can look forward to more from Bob at 9 a.m. UK time. He is going to join Bloomberg Radio. You can get that on London DAB digital radio if you're in the city. Let's get the Bloomberg Business Flash now. We go back to London for that with Laura Wright. Laura?
Thanks, Matt. Rio Tinto is reporting a 20% jump in annual profit, its biggest result in 9 years. It also plans to boost returns to shareholders, paying out a record $9 billion in dividends. The world's top iron ore producer was helped by surging prices for the metal. It continues the strong run of earnings from miners. Berkshire Hathaway has trimmed its Apple stake and snapped up shares in 3 new companies, Verizon, Chevron, and insurance broker Marsh & McLennan. The reduction in Apple left Warren Buffett with a stake valued at about $120 billion at the end of 2020. The iPhone maker remains his biggest single stock holding. Citigroup is struggling to recover $500 million it accidentally paid out due to a 30-year-old legal precedent that it's effectively finders keepers. The bank is appealing the decision that lenders to Revlon can keep the money. Last summer, Citi meant to send them an interest payment, but ended up including the principal as well. That's your Bloomberg Business Flash. Matt.
Laura, thanks very much. Laura right there in London with your Business Flash. Coming up, Qatar's plan to keep the LNG top spot. Our exclusive interview with the energy minister of the world's largest producer of liquefied natural gas is next. This is Bloomberg.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
This is the 1980s all over again. To make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Welcome back to Bloomberg Markets. This is the European Open right now, 21 minutes into the trading day, and looking at drops of 0.5%, a little bit more across European equity indexes. Let's get to an exclusive interview, though, right now. The world's biggest producer of liquefied natural gas has told Bloomberg it's planning to expand operations and to remain the top supplier for the next 20 years. Qatar's energy minister, Saad Sharida Al-Kaabi, spoke with Simone Foxman in Doha. She started by asking him about the current energy crisis in the U.S.
Of course, the crisis today in Texas is something that hasn't been seen before. I mean, for Texas to get, the temperature they have and the snow and the ice and so on is something unheard of. I think this is a one-time event in, a few centuries, I think, or at least few decades. We've not seen something like that. I personally lived in Texas for some time, so I know that they are not used to snow. And, of course, all the facilities and everything around the oil and gas, infrastructure is not set up in that area. Maybe in the north they are, but not in the south. So it's a temporary thing, and hopefully they'll get things back to normal soon. But it did disrupt, the oil market, especially in that region. So I wish them.
You think it'll go away? It will.
Yeah, I'm sure they're very resilient. I mean, the oil and gas industry in the U.S. is very resilient, and I'm sure they'll get over it soon.
Well, you're about to undertake, as head of QP and Energy Minister of Qatar, a massive expansion of the country's LNG capacity. Explain to me, you had this on the books for a long time, but it was delayed just slightly with the coronavirus. Why now? How does this work out as an investment and a market thesis?
As far as the Northfield expansion projects, we have two projects, Northfield East, which we just announced sanctioning, and the Northfield South. So the Northfield East would take us from 77 million tons to 110 million tons per annum. And then Northfield South, which we will announce early next year, will take us to 126 million tons. We've announced our strategy. Our strategy is very clear and is defined. These are very robust projects. We just mentioned last week that the total project cost for Northfield East is $28.75 billion to produce 32 million tons per annum of LNG by 2025. This is one of the most competitive, if not the most competitive project on the planet today. And we're very proud of that. And we're moving ahead for our long-term vision of reaching 126 and maybe more.
Qatar's energy minister, Saad Sharida Al-Kaabi, talking with our own Simone Foxman. Let's take a look at what's on the move this morning. For that, we go to Danny Berger in London. So, Danny, we've already looked at Kering shares, but they're moving now even lower because of the sales problems at Gucci.
Yeah, and just to give you some perspective, at an 8% decline, if it holds this throughout the rest of the day, that's going to be its biggest drop since March of last year. So really when the beginning of the pandemic took hold in Europe. And this is still part of it. We still have stores closed because of European closures and their move to wholesale for Gucci, trying to better rein in their image, but that's had an impact on sales. Hargreaves Lansdown, another one of the big drops today. This is because Hargreaves himself has sold some of his share in the company. He sold about $420 million worth. Of course, he's still one of the biggest shareholders of the company, and we have seen both Hargreaves and Lansdown cut back on some of their holdings of the overall asset manager. Akzo Nobel up 2%. Matt, you spoke to the CEO earlier. Of course, the big payout for shareholders, top of mind. Let's take a listen to that.
The valuation went to a point where we could not justify anymore to do it. Not everything that you can do, you should do. And in fact, as a result, we felt in the decision point to doing a share buyback versus somewhat irrationally chasing that target, that the share buyback was by far the most value creating for the company and for its shareholders.
So not looking at more purchasing or acquisitions, instead buybacks. Quickly, I want to do a market check. U.S. 10-year falling below 1.30%. It has some of that reflation trade taken a breath. Well, not really if you consider Bitcoin a reflation bet, which some people are starting to. That's still trading at a record high above $50,000. Crude also still getting a bit, perhaps reflation trade, but of course, we still have the Texas situation and the cold there as well impacting prices, Matt.
Danny, thanks very much. Danny Berger there going over some of the moves in these markets that we need to keep our eye on. The Italian Banking Association says lenders need more flexibility to keep the real economy going. We speak to the general manager of the group, Giovanni Sabatini. This is Bloomberg.
Okay, ladies and gentlemen, good morning. Money never sleeps. Yep. What I showed you is I place a stop on Suicide. So if you follow my trades, please do so. To place stop on all our positions at 0.8963. Okay. So if it reaches this level, we will sell all three positions. See you later, guys.
Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
Welcome back to Bloomberg Markets. This is the European Open, 30 minutes into the trading day right now, and we're looking at stocks that are down across the board. About 0.3% on the FTSE and the CAC 40. The DAX in Frankfurt is down almost 0.5%. If you use the group ranked return screen, you can see which industry groups in the broader index are doing best and worst. Here it is for the Stock 600. You could put any index in the yellow box there, and almost any index, and analyze it by industry groups. Basic resources doing the best, as well as energy. So it really is the continued rally in commodities that's helping to hold up those groups. On the downside, you've got retail, as well as personal, consumer, drugs, and grocery stores. We talked to Ahold earlier. Although they missed estimates, they are doing a buyback. And financial services. Interesting to see financial services down, the third biggest losers. Banks up, the third biggest gainers. Let's get the Bloomberg First Word News now. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. Well, as you just showed, what's affecting energy, the deep freeze that has forced the shutdown of U.S. refineries and left millions without electricity could continue for days. To prevent the collapse of their network, suppliers from North Dakota to Texas are implementing rolling power cuts. Authorities are warning Houston residents to stay off the road amid plunging temperatures and an ice storm. The U.S. House is putting President Biden's stimulus plan on the fast track, aiming to vote on the $1.9 trillion bill on February 26th. The tight timeline reflects the urgency of new support as the current aid package expires on March 14th. Democrats are looking to put the former president's impeachment trial behind them and move on with other priorities. Brexit is hitting London's efforts to compete with New York as the world's top financial hub. According to a survey, only 31% think the UK capital comes out on top versus 60% for New York. That's a reversal from 2018, when over 50% saw London as the world's top centre for finance. Only 12% think leaving the EU has made London stronger. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt.
Laura, thanks very much. Laura right there with your First Word News. Now, former ECB President Mario Draghi will give his first address to the Italian Senate as the country's premier. He will outline his main policy goals before a vote of confidence. Faith in Draghi's ability to steer the economy was clear after record demand for the Italian bond sale yesterday, but there's more to be done. Italian and German banking associations are calling for a more flexible approach on some European regulation to allow banks to keep lending to pandemic-struck businesses. For those details, we go to Maria Tadeo, who is in Brussels with a guest. Maria?
Yes, Matt, and we're joined now by Giovanni Sabatini, who is the General Manager at the Italian Banking Association. He's joining us from Rome. And Mr. Sabatini, when you look at Italian banks, it's very clear that you're benefiting a lot from the Draghi trade. But I do wonder, what do you want to see from Premier Draghi now in politics to continue to benefit from that momentum?
Well, good morning. Good morning from Rome. Well, we expect that Mario Draghi will put pressure on the finalization of the Italian Recovery and Resilience Plan. We think that it's extremely important to boost investment, to recovery trust, and I think that markets have positively reacted to the appointment of Mario Draghi as a new Italian Prime Minister. The BTP spread is well below 100, is pointing below 90 at the lowest level in the recent years.
And I wonder, you know, Mario Draghi is now in politics, but he was a former central banker. You know, there's been this idea pushed by central banks, especially the ECB, that we need to see more consolidation to make the financial services industry better and more resilient. Is that something that you would agree from the Italian perspective? There needs to be more consolidation?
Well, Italy has already on the edge of this process with the consolidation of the cooperative banks into major cooperative banking groups, the acquisition of UBI by Intesa Sanpaolo. So the Italian banking sector is very active, not only in the consolidation, but also in restructuring, progressing. The number of branches is dramatically reducing. The cost-to-income ratio is among the lowest in the major European countries. So, and particularly Italian banks have made enormous progress in improving the asset quality, the reduction of NPLs that were the legacy of the great financial crisis has been really impressive. Today, we reached minus 70% from the peak touched at the end of 2015, and the NPL gross ratio is now close to 5%, the threshold identified by the European Banking Authority as the to identify the high NPL banks.
And now that you mentioned NPLs, you know, I want to focus on that because we know this is going to be an issue, potentially a problem after Corona. You're saying in a paper that you've signed with the German equivalent of the Banking Association in Italy that NPLs need to be treated differently in this crisis. What do you mean by that, especially when it comes to the provisions?
Well, we think that today banks are playing a key role in supporting businesses and households to withstand the liquidity stress caused by the pandemic crisis. And therefore, we think that rules that were adopted in a completely different situation, the big financial crisis, are not appropriate to address the current situation. What we are pointing at is the mechanistic and procyclical approach that is embedded in some rules. And therefore, we, together with our German colleagues, are urging European authorities to allow for more flexibility to support, to help banks to continue to support businesses, for instance, through forbearance measures.
I see. And just a final question very quickly, since we're running out of time. How big can that NPL ratio go in the Italian banking sector? Do you worry about that shooting up again?
Well, of course, because of the intensity of the crisis, the NPL ratio will grow, particularly in 2021. But as it has been pointed out also by Governor Visco, we don't think that the NPL ratio will reach the peaks that we have experienced during the Great Financial Crisis. And also, based on the previous experience, Italian banks are well equipped to manage the potential increase of NPLs.
Right, well, thank you so much for joining us. That's Giovanni Sabatini, who is the general manager at the Italian Banking Association, joining us from Rome as we wait for Mario Draghi to begin his speech in about 20 minutes. Matt?
All right, Maria, thanks very much. Maria Tadeo there, our reporter in Brussels with Giovanni Sabatini, general manager of the Italian Banking Association. Coming up, losing its luster, gold extends declines. We'll discuss the outlook for the precious metal next. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to Bloomberg Markets. This is the European Open. We are 42 minutes into the session right now and looking at red arrows here across the board. Not big drops, but 0.3% on the FTSE as well as the DAX. Let's get the Bloomberg Business Flash. For that, we go back to London and Laura Wright. Laura?
Thanks, Matt. Nestle has agreed to sell its bottled water business in the US and Canada to private equity firm One Rock. The $4.3 billion deal comes as the food giant continues to revamp its portfolio. Nestle's premium international brands like Perrier and San Pellegrino are not part of the agreement. Rio Tinto is reporting a 20% jump in annual profit, its biggest result in 9 years. It also plans to boost returns to shareholders, paying out a record $9 billion in dividends. The world's top iron ore producer was helped by surging prices for the metal. It continues the strong run of earnings from miners. Well, Matt, as you're discussing with Bob Parker, car sales in Europe have plunged to a record low for January as the coronavirus continues to hit the continent's biggest market. Registrations were down over 25%, with Spain seeing a drop of more than 50%. Many manufacturers are having to rely on demand from China. You know, one day, Matt, I will be able to talk to you about new cars, but I guess for now I have to deal with my fold-up bike. Anyway, that's the Bloomberg Business Flash. Matt.
Too cool for school with the fold-up Brompton bicycle. Laura Wright.
You should get one.
Out of London. Thanks very much. You know what? I actually have a bike that collects dust because I tend to ride motorcycles. And I can't imagine putting on spandex and those little cleats when I could instead don a helmet and rip around the city on a Ducati. In any case, I will live vicariously through you. Laura Wright there in London with your business flash. Now, gold is extending declines as treasury yields hold near their highest in a year. That's on expectations the economy is recovering from the pandemic's impact. My next guest, however, thinks there is much upside for gold in the long term. This is demand rises, but supply is short and will continue to decline. Obviously, it's a finite resource. Joining us now to talk is James Raste, Coast Capital CIO and founding partner. James, before we get to reasons to buy, it seems to me as rates rise, that's when we see the price of gold go down. My old friend Pim Fox always used to remind me, gold doesn't pay a dividend.
Good morning. That is correct. Rates rising has taken some luster off of gold, and I think that perhaps the extraordinary excitement around Bitcoin, which is like a new toy thrown into a den of cats, has subluster of gold as well. But we're really pleased with that. It gives us an opportunity to buy stakes in wonderful gold miners that have very, very high margins that are like twice the S&P on average, and that generate, like, we're buying companies at 1x cash flow. You know, so it's a completely neglected sector. We're very happy for gold to be selling off for the time being.
Yeah, I've wondered this entire time. We watch Bitcoin go from, well, over the last 6 months, really, like less than 20,000 to more than 50, why gold hasn't come along for the ride. Because the reasons for Bitcoin's rise, at least a lot of them, seem to be all of the money printing going on, the Fed balance sheet blowing up, the big borrowing that the U.S., well, and all Western governments are doing. Why hasn't gold been on the rise at the same pace as Bitcoin?
Yeah, no, look, if you look at, I think that's absolutely correct. But look, I think it's really important to remember that monetary policy affects the price of specific assets like gold, but with some delay and notable delay. So I really don't think that gold has reacted to the tsunami of money that's been printed across the world. If you look at gold as a percentage of monetary supply, it's at all-time lows currently. Right? So gold has been as undervalued against money and fiat currency as it's ever been. I think that, again, there's a lot of excitement around Bitcoin, which, you know, I would be absolutely not surprised at all to wake up in a world 10 years from now where Bitcoin is worth zero. Perhaps because it's been outlawed by some governments that have launched their own versions of cryptocurrencies, which is what they insist on their citizens using. So, you know, I'm very pleased with gold selling off for the time being, because again, it gives us an opportunity to buy more gold miners at very attractive prices.
James, speaking of, you are, if I'm not mistaken, you're on the board of Human Rights Watch. And one of the things I wonder when going out and trying to decide which gold coins to buy, you know, where to get the supply, is there a place that kind of can guarantee ethical production?
That's really a wonderful and important question. So I think that the World Gold Council has actually done some very good work around that. And I think that if you procure your gold through Western government printing or mints, you are by and large pretty well guaranteed to have ethically sourced gold. What I am particularly excited about with gold production, gold miners, though, is that there are, like, a lot of people don't invest in the industry because they view it as a pollutive industry. And guess what? Every extractive industry is, right? But guess what? We also a world that's trying to go electric, which means that we need more metal, and every single processing, like, you know, core for a telephone or a computer has an important amount of gold and silver and other metals in it. So what I'm really excited about from an ESG perspective is the fact that there are cleaner extraction technologies and processes that can be and must be adopted by the industry. And as investors, we're trying to really push these more aggressively.
So is that how you want to, I mean, right now, what do you think is the best way to invest? Do you want to buy Krugerrands and Maple Leaf directly, or do you want to buy the ETF? Do you like the miners?
Look, so I'm Canadian and I'm a deep value guy. And if you look at these gold websites, the Maple Leaf always trades at a discount to the Krugerrand or to the US Liberty coins or whatever nonsense. So I'm a Maple Leaf man through and through. However, the very best way, I think, if you're interested in important upside to invest in the gold mining sector, is to buy the small and mid-tier gold mining companies. Here's what people don't understand about gold and gold miners. I think, like, it's shocking to me that it's as misunderstood as it is. We live in a world that's running out of gold, right? For every ounce that we take out of the ground, we're only discovering 0.2 ounces. And the quality of the gold that we're discovering is very, very low. So the majors are running out of gold. And the major gold miners, because they're big parts of the ETF, traded twice the multiples of smaller companies that very often have much longer mine lives. And so we believe that the majors are going to continue to be bought by the juniors and mid-tier miners will continue to get bought by the major gold miners. And we think that the majors can afford to pay like 100% premium for some of these smaller companies and still have a great deal on their hands. So we're buying small and junior gold miners, and we're generating returns even in an environment where the price of gold declines.
All right, fascinating stuff, James. Hope we can get you back on because I love this topic. James Roste, Coast Capital CIO and founding partner, talking to us about gold. Coming up, how far will 10-year Treasury yields rise? That's an important question if you're a gold investor. We'll put it to MLive's Van Rom next. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
By the end of July, we'll have over 600 million doses, enough to vaccinate every single American. We got them to move up the time because we used the National Defense Act to be able to help the manufacturing piece of it, to get more equipment. The overwhelming consensus is, in order to grow the economy a year, 2, 3, and 4 down the line, we can't spend too much. Now's the time we should be spending. Now is the time to go big. It is estimated that if we pass this bill alone, we'll create 7 million jobs this year.
That was President Joe Biden there advocating for his $1.9 trillion pandemic relief plan in his first town hall event since taking office. Let's turn to the markets now. The Stock 600 index drops for a second day, weighed down by retailers. Treasury yields hold near their highest level in a year. That's as investors assess the impact of a bond sell-off on other assets. And on the cryptocurrency front, the Bitcoin rally continues, bringing the coin to another new all-time high. Joining us now is Ven Ram, Bloomberg's MLive currency and rates strategist. Now, Ven, I want to kick it off with Bitcoin, which isn't, according to any country, technically a currency. Of course, no central banker would want to have that be the case, but some investors really think it is. What do you make of the rise?
Well, it's a phenomenal rise, Matt, whichever way you look at it. I mean, in such a short span of time. But you know, if you look at it, if you look at it as an asset, it does come up short on many counts. It comes up short as a currency, as a unit of exchange, and definitely as a store of wealth. If you want it to be exchanged and fungible at traders, merchants, one thing that's got to go right for it is the level of volatility, which is phenomenally high. I did a story yesterday that showed that the volatility is 75% annualized volatility on Bitcoin. That's phenomenal. No merchant is ever going to say, oh, Bitcoin is fine, because he doesn't know what it will be valued the next day. So
now, Ben, I don't know if you can argue it's not a good store. I don't know if you can argue it's not a good store of wealth. When you look at this chart, I think you'll change your mind. I mean, if you put $1,000 into Bitcoin 10 years ago today, you'd have $51 million. As far as I'm concerned, that's a pretty good store of wealth.
Well, yeah, I see what you mean, Matt. I don't know if that's a very good lottery, but is it a very good store of wealth will be determined by what it does over the next 20, 30 years, not by one rally that's taken it. Of course, it's risen since 2010. Of course, it's risen a whole lot, and that's why everyone is jumping onto the bandwagon, because it looks like gravy train.
Yeah.
But how long will the gravy train keep going? Is it going to go from 50,000 to 500,000, from 500,000 to $1 million? Let's find out, Matt. I mean, yeah. I did a study last week as well, when we discussed that, I think, on the show. If Tesla has got to earn its own return on equity of 5.5% on its Bitcoin investment, Bitcoin needs to be trading at $500,000 20 years from now.
All right, well,
if you think
listen, I'm going to save this piece of tape, Ven, and we'll come back and check it in 20 years. Ven Ram, Bloomberg's MLive currency and rate strategist. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Texas to get the temperature they have and the snow and the ice and so on is something unheard of.
The famous stimulus, I mean, it seems to me likely that going too far in the case of the U.S.
Time is your friend here and leverage is your enemy, and because leverage is uncontrollable.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Welcome to Bloomberg Surveillance, everyone. The early edition this Wednesday, February 17th. I'm Francine Lacqua here in London, and here's what's coming up on today's show. The big freeze in Texas hits both companies and consumers. Oil production in the Permian Basin slumped by 65% as millions face an extended blackout in the Lone Star State. We look at the global ramifications. Bitcoin breaks out. The digital currency hits a new record above $50,000 and holds on to gains this time around. Is crypto finally getting the backing to go mainstream, or is this just another sign of froth in the markets? And Draghi goes to auction. Italy's new prime minister amasses a record bond sale. Today, we speak exclusively to a man who knows Mario Draghi well. At 9:30 a.m. London time, the Societe Generale chair, Lorenzo Binismaghi, joins the show. So let's stick with our top story, and the deep freeze that has caused chaos in the U.S. energy market shows no sign of ending soon.
It is simply unacceptable at this point for people to be without power.
One of the problems is that our system is an isolated system.
We're going to have to take a stronger look at who's allowed priority on our grid system. Right now, we're saying that the renewable energy has that priority, which is discouraging our reliable energy source, which seems to be more natural gas, fossil fuel related.
This is a timely reminder for a wake-up call, really, and saying that, yeah, we absolutely need fossil fuel in the mix.
It's a temporary thing, and hopefully they'll get things back to normal soon. But it did disrupt, the oil market, especially in that region.
Oil production in the U.S. slumped by 1/3, the most ever, as a result of the extreme weather. Now, Occidental issued a force majeure notice to suppliers, while Chevron has shut its wells in West Texas. More than 3 million Texans could also be kept in the dark for days as utility providers continue rolling power cuts. Now, the crisis could soon turn global as it slows LNG shipments from the Gulf Coast. Well, let's bring in our chief energy correspondent, Javier Blas, who's been following, of course, that story very, very closely. First of all, Javier, how bad, how long will this last? And when are you expecting to, for everything to get back online?
Well, it's quite bad. As you mentioned, we are in 48 hours of these rolling blackouts in Texas, and it's not longer rolling. Some people have been without power for more than 40 hours already. We don't see any sign yet of the situation really improving on the ground. I was just checking on the Bloomberg terminal, the amount of power that the Texas grid is able to supply, and it remains about 45 gigawatts. That's exactly what it has been over the last 24 hours. And with that amount of power, that is not enough to supply the whole state. So two things need to happen. Probably temperatures to get a bit warmer, so the demand for power will come down, and for more power generators to come online. But there is a problem because there is not enough gas for that generation to happen. So I think that we are going to still see more blackouts today, potentially tomorrow, and probably some people will remain without power, potentially going even into the weekend.
Javier, what about gas prices for people on the ground? How expensive is it to fill up your car now?
Well, prices for refined products, for gasoline and diesel are increasing in the region. We are hearing reports of shortages, particularly of gasoline in West Texas, which is ironic because this is one of a region that sits on top of one of the world's largest oil fields. And if you
Sorry guys, just to point out for C, to be more precise, you need to move up 1 pip if you want to sell on profit with zero hedging without any loss. On your long positions, you have to put 1 pip up to 0.8964, from 63 to 64. Okay? See you later, guys.
By 30,000% over the last 2 weeks.
Javier, what about companies that are being hit hardest? What are we looking for?
Well, we are looking at all kinds of companies in the Gulf Coast of Texas affected, big industrial producers, chemical companies that have seen their gas supply cut off, their power cut off. The industrial heartland of the refining industry in Texas, in the United States, is down. We have lost millions of barrels of processing capacity. And if you're thinking about oil companies, we are seeing many producers of oil in the Permian and the Eagle Ford, that's the two big regions of oil producing in Texas. They are having to issue force majeure, that's a legal clause that allows them to not fulfill legal contracts of supplying customers just simply because their wells are frozen and they cannot pump oil.
Javier, thank you so much. Let me tell you about Javier. He has a great 2 or 3 terminal screens. He looks like the Wolf of Wall Street of commodities, but he also has a new book out, and that is something that you don't want to miss. He also plugged it right behind him on his left. I would urge everyone to pick it up when it's out. It's called The World for Sale: Money, Power, and Traders Who Bartered the Earth's Resources. It's out on February 25th, and of course I expect not only Javier to send me a signed copy, but also to come on the show to talk about it extensively. It's a fantastic book. Now, let's also focus on COVID-19 and some of the vaccines out there. Remember, it was the start of the year where there was this huge fallout between the UK, between AstraZeneca and the EU, because the EU has been really lagging behind in terms of the number of doses and its vaccination program. Moments ago, breaking, Pfizer and BioNTech will supply the EU with an extra 200 million extra vaccine doses. So we'll have plenty more, of course, on that, what it means for Pfizer. AstraZeneca was providing the COVID vaccination at cost. I don't think it's the case for Pfizer, certainly not for the UK, but I'll dig into that a little bit deeper. Now, Bitcoin rallying again today, setting another all-time high after breaching $50,000 for the first time yesterday. Here to wrap up all of the crypto moves is Bloomberg's Danny Berger. Danny, 50,000 and it's staying there for now.
I know, look, it really feels like the laws of gravity do not apply to Bitcoin at the moment. Not just 50,000, Francine, but in the past hour, 51,000. I got your 2-day, 3-day chart here, and you can see it really just continues to take off. And I think the interesting debate that arises from this is this a picture of speculative froth in the market? Is this a sign where we have these corners of the market that look kind of bubbly? Or is this just because more institutions are adopting Bitcoin, perhaps as an inflation hedge on their balance sheet? But I want to quickly take you into the terminal, because if we're talking about Bitcoin being any sort of hedge, the volatility picture probably needs to change. At least that's according to JP Morgan. So 90-day volatility here on the blue, it's creeping up, not as high as it was in 2017. But they are saying at JP Morgan, unless this comes down, we're going to see some of the rally in Bitcoin fizzle, because it's not really good to have such a volatile asset on your balance sheet. If you're a company, institutions looking at it, it gets less attractive because of the volatility, Francine.
Danny, thanks so much. Our Danny Berger there with the very latest on the crypto. And of course, we'll also have a full roundup of reflation. Now, we're seeing live pictures of the Italian Senate, where Mario Draghi is expected to deliver his first speech as Italian Prime Minister. Yesterday, of course, he managed to get an early endorsement from investors in the shape of a record bond sale this week. So we'll have a look at where now he spends the money, or he wants to spend the money in terms of priorities for the EU funds that he'll have access to. Now, Smart Conversations on Surveillance Early Edition. Yes, this morning we'll be speaking to a man who knows Mario Draghi well. He's Lorenzo Binismaghi, the chairman of Société Générale and former ECB policymaker. You don't want to miss that interview. It's at 9:30 a.m. in London, and this is Bloomberg.
have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition, and I'm Francine Lacqua. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The U.S. House is putting President Biden's stimulus plan on the fast track, aiming to vote on the $1.9 trillion bill on February the 26th. The tight timeline reflects the urgency of new support as the current aid package expires on March the 14th. Democrats are looking to put the former president's impeachment trial behind them and move on with other priorities. Now, Singapore plans to rein in its budget deficit, digging deeper into government reserves for a new stimulus package of around $8.3 billion. It comes after the nation's biggest ever contraction in 2020, with GDP falling over 5%. It is expected to rebound this year, but the outlook remains challenging.
It will be, one of our biggest budget so far. The recovery is as we expect. Our sort of central scenario, then I think we should be able to balance our budget over this term of government.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, yields on treasuries have hit their highest in a year as the reflation trade continues to power the markets. Now, the sell-off in bonds has seen the 10-year extend above 1.3%, which has knocked the wind out of equities this morning. Well, joining us now is Karen Ward, JP Morgan Asset Management Chief Market Strategist for EMEA. Karen, thank you so much for joining us. How much does this reflation trade continue?
Well, I think it still has room to run, because I think although it's a consensus that by the second half of the year, the vaccine rollout has proceeded across most of the developed world and we're seeing a strong bounce back. There are still some nasty left side tail risks. We still are learning about virus mutations and quite the breadth to which restrictions are going to be eased. So I think as we go through the next few months, I think that confidence in the shape of the recovery can still grow, and therefore some of the cyclical catch-up can continue, and that will continue to push bond yields higher.
When we look at some of the inflation forecasts, and let me bring you over, Karen, to something that the San Francisco Fed President Mary Daly said, the inflation risk should not be a primary concern. So she says exactly we should be less fearful about inflation around the corner and recognize that fear costs millions of jobs. I mean, the reflation trade, is it on the premise that actually the Fed is going to do something and readjust monetary policy, or is it just driving yields and therefore driving the rest of the markets?
Well, I think, first of all, I'm not sure I agree with that point about there are no inflation risks. I think there are plenty of inflation risks. I mean, we really don't know how much this pandemic has impacted supply and the speed with which demand picks up relative to supply. I think we could be surprised by the degree to which inflation picks up in the short term. And then even for the next cycle, I personally feel one of the reasons inflation was so low in the last cycle was because governments were so focused on austerity, and a public sector pay freeze as an environment. I think it's very hard to generate inflation. And I don't think governments globally are going to turn back to austerity. I mean, just look at what Joe Biden is trying to push through in the States, you know, an enormous stimulus package into the recovery, very different to what Obama managed to get through. So I think, you know, that real growth, because I think we need to split out a really important point here, is that reflation trade we need to split out between what's happening to growth and what's happening to inflation. As long as we're seeing a fully fledged growth recovery and it's really growth that's driving that reflation, that's absolutely fine. And a little bit of inflation alongside that will all be very healthy for global stocks. And even if yields are rising, as long as earnings are rising by more, I think that's okay. The risks are actually that it's the inflation story that's surprising us.
But Karen, I think what we keep on hearing from, you know, Federal Reserve members, and I don't know whether you agree with, you know, what the market is looking at, is that as long as it's around the 2, maybe even 3%, central banks will look through that inflation. Do you think they will, or would you question that? Does inflation need to hit 4% for us to be worried about, you know, a change in monetary policy?
You're right, Francine. I mean, the Fed wrote the minutes almost for the equity market, it felt like to me last time. You know, they said inflation is going to rise in the near term. We're fully expecting it. A 3% number is absolutely on the cards. And we're not worried about that. It's going to be transitory. It's not going to impact our course of policy. And I think they will stick to that. And I think globally, if we see, you know, the UK inflation number pushing up to 2, which it's likely to, and the US number pushing up to 3, then that's not a problem. I think the risks come if instead of 3, it's 3.5, and maybe it's in areas of the basket where we weren't expecting, which aren't so obviously transitory. So I think it's the detail and the unexpected surprises. That's where there's greater risk.
Karen, thanks so much. We'll get back, of course, to Karen Ward, and we'll have plenty more on the reflation trade. And we also have a great call, actually, by Citigroup about a 10% correction. So I'm interested to hear Karen's thoughts about that. Now, coming up, Rishi Sunak's £60 billion nightmare. The UK Chancellor gets a warning that he will need to substantially increase taxes if he's to balance the nation's books. We'll have plenty more on that. This is Bloomberg.
landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition, and I'm Francine Lacqua here in London. Now, Rishi Sunak gets a stark warning ahead of next month's budget. The Institute for Fiscal Studies tells the UK Chancellor he will need tax increases of about £60 billion if he wants to balance the books. On March the 3rd, Sunak is due to outline how he intends to address the ruinous legacy of a pandemic that has driven UK borrowing to its highest in peacetime. Well, we're back with Karen Ward of JP Morgan Asset Management. Karen, if you look at some of the UK assets, I mean, pound was one of the best performing currencies. There's a little bit of movement also on gilt. Is there any appetite for buying UK right now?
Well, I think we have to separate what aspects of the market. So I certainly think the UK economy is looking in good shape. The vaccine rollout's going very well. The recovery looks good. Perhaps the near-term Brexit distortions haven't been as bad as feared. And the Bank of England, because of all that, is nearing off of negative interest rates, and the next move is now looking more likely to be up. And that's why the pound is bid and probably could go a little bit further. We still think it's slightly under fair value. I think when we think about UK stocks, we've just got to remind ourselves the composition of the UK market, because very rarely is the stock market the economy, but in the UK, very much so. 70% of the FTSE 100 earnings come from elsewhere in the world, and it's very heavy in energy, in miners, and in financials. And there's, there are some tailwinds to some of those areas of the market. Clearly, the rise we've seen in oil prices is helping, but of course, the sterling rise, it takes some of the shine off that repatriated earnings. I think for the UK market to really start to outperform, we probably need that global financial story to really start to take flight, and there probably is prospect for that over the next 18 months or so.
Karen, how much does it have to do with actually, the vaccination drive? And, something that caught the team's attention was an FT story today saying that the UK could actually make company vaccinations mandatory, or employers saying, look, if you want to come and work for me, you have to have a vaccination. I know there's ethical questions, but overall, is the UK getting it right in how to deal with the doses, the vaccines, or is it too early to tell?
I think it's difficult to know about the sort of dosing strategy at this stage, but certainly when we look at speed of rollout and getting the vulnerable components of the population vaccinated, it's going terrifically well. I mean, your chart here shows that perfectly, hitting all of the milestones, in fact, being ahead of many of the milestones in terms of getting that vulnerable population, and the infection rates are falling sharply. So I think the critical question now is, does that vaccination program keep those infection rates down? Do we phase out the reopening sufficiently slowly so that it doesn't reaccelerate in the way that it did last year? But overall, I would say, seems to be going terrifically well.
Karen, we also had a strategist at Citigroup basically saying that a 10% correction in U.S. equities is not implausible. Are you expecting a correction anywhere in the market today?
Well, I mean, I suspect they're talking about the reaction of stocks to higher bond yields. And I think that is one of the key questions. If bond yields move higher, is that going to put at risk, the risk asset recovery, not just stocks, but maybe the higher risk areas of fixed income? Our assumption is as long as earnings are moving more quickly than yields are rising, then stocks are going to be okay. Usually we've seen that in the past. Bond yields have been rising alongside stock prices, and that's because the underlying driver is just that the recovery, the outlook is looking that much better. I think, though, however, it could benefit certain areas of the market and put other areas of the market perhaps at slightly more risk, because I do think last year the combination of the impact of COVID on the economy plus low interest rates was very good for certain tech areas of the market, and obviously very bad for other areas of the market, cyclicals and financials. And therefore we could see that rotation as the reopening progresses and we see higher yields and steeper curves away from the sort of beneficiaries of the former weakness, if you like, towards those losers. So I think it's more for me about rotation rather than absolute correction.
Thank you so much, Karen Ward there, JP Morgan Asset Management Chief Market Strategist for EMEA. Now, we're also looking at live pictures of the Italian Senate, where Mario Draghi is delivering his first speech as the Italian Prime Minister. He's told MPs that his first duty is to fight the pandemic and save lives. Now, yesterday we had the first Italian bond auction since the new Prime Minister took over, and he really got an early endorsement from investors who seem to have flooded a government debt sale with orders allowing the country to secure a better price than it had initially targeted. Smart Conversations on Surveillance Early Edition this morning will also speak to a man who knows Mario Draghi well. He is Lorenzo Binismaghi, the chairman of Société Générale and a former ECB policymaker. Now, don't miss that conversation. It's coming up, but you can also IB us. You can IB me directly or IB Plus TV if you have any questions about the banking sector, any questions about Italy, or even about SPACs in the banking space. Why not? IB me. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The big freeze hits both companies and the consumer, while oil production in the Permian Basin slumps by more than half. Millions of Texans face an extended blackout. Finders keepers, Citigroup unexpectedly loses a legal battle to recover $500 million it sent to Revlon lenders by mistake. And Draghi's debut speech, Italy's new prime minister amasses a record bond sale. Up next, we speak exclusively to a man who knows Mario Draghi well. The Société Générale chairman, Lorenzo Binismaghi, joins the show. Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, a lot's going on in the markets, but even more interesting, the latest round of 13Fs are out, giving a quarterly peek into what hedge funds are buying and selling. Well, Warren Buffett's Berkshire Hathaway made a big splash with its filing cutting its Apple holding during the last few months of the year. Well, joining us to break it down for us is our Danny Berger. Danny, he's cutting Apple.
Yeah, that's right. And look, he still holds a lot of Apple, over $120 billion worth, still one of the biggest holdings. But in cutting it, it means he can also pivot away and look at different stocks. So here are 3 shares he added. I have the after-hours trade from yesterday because you can see the impact when Warren Buffett's Berkshire Hathaway buys. You get rallies for all these stocks. And he did buy sizable amounts, about $4 billion valued at Chevron, over $8 billion when it comes to Verizon. So, of course, people reacting to that, I should say. Buffett also trimming some of his bank exposure as well, possibly a reaction to some of the COVID pain lenders have been feeling.
How did hedge funds actually treat some of the big IPOs last year? Did they buy into these newly listed companies, Danny?
Yeah, they did, and in a big way, too, which is interesting because we've been talking about this possibly being the sign of a bubble, but we saw Tiger Global, for example, make big bets on both Airbnb and DoorDash. Coatue is one of the hedge funds that participated in the early rounds of DoorDash. It didn't sell out on its IPO, so now its holding is worth about $1.25 billion. I should say we also saw a little bit of SPAC buying as well, one EV SPAC in particular. So hedge funds still buying into these rallies despite, again, Francine, some of the warnings we've been hearing that perhaps the IPO frenzy, the SPAC frenzy, represents an overheated market.
Thank you so much. Our Danny Berger there with the very latest on Berkshire Hathaway. Now, Mario Draghi gets an early endorsement from investors in the first bond sale since he took over as Italy's prime minister. The country racked up record orders, allowing it to secure a better price than expected. Italian bond yields tumbled to a record low last week on signs that Draghi would lead a government with near unanimous support. Now, our next guest not only is a current chairman of one of Europe's biggest banks, but back in the day, he also worked at the ECB as a policymaker alongside Mario Draghi himself. Now, he was a member of the executive board and governing council between 2005 and 2011. Well, joining us now is Lorenzo Binismaghi. He's Societe Generale chairman and former ECB policy maker. Mr. Binismaghi, thank you for joining us. I have a million questions ranging from reflation to banking to Mario Draghi. But Mario Draghi, just moments ago, giving the speech in the Italian parliament, actually talking about budget. So this is the very latest from Mario Draghi, basically saying that the EU needs a common budget to combat recessions. Is this a Mario Draghi that will change Europe even more than he will change Italy?
Well, the two things are linked. If Mario Draghi is successful in adopting a recovery plan, in adopting the reforms in Italy, then he will contribute to make a stronger Europe because he will convince all countries, including those that are a little bit more reluctant, that Europe needs to move forward, to integrate further, to have a common budget, and so on and so forth. So the two things are linked. A stronger Italy will make Europe stronger.
But what needs to happen for that to be a reality? You know, if you look at your time at the ECB and what Christine Lagarde is facing now, do we need full convergence of the insight actually of how a country balances the books before we think of common budgets?
Well, I mean, first, I would say that we have a recovery fund that provides Italy with a lot of money. But Italy needs to be able and to show that it can spend this money in a way that improves its growth potential. One of the problems of Italy over the last decades has been its inability to spend properly and a growth rate which was substantially below that of others. So if Mario Draghi can make these two changes, spend well and improve the growth potential of Italy, then the public finances problems will be solved by itself because we will get all out of these high debts only with growth. That's the only way.
How do you look at growth? So there's, a lot of things going on in the markets. There's a reflation trade that's moving yields, that's, leading market participants to questions what happens with their assets. There's a vaccine story. There's the trade concern. Like, what do you think will drive markets this year?
Well, and there is the huge expansionary fiscal policy implemented in the US, which is obviously unprecedented and is creating a lot of discussions and debates even among academics. And this clearly will make a difference. The whole issue is, will these packages create a permanent inflationary shock, or will this be temporary? And my personal view is that we are coming out of this crisis with a lot of savings, a huge output gap. So it is still needed for the world economy, in particular the US and Europe, to have a reflationary policy, expansionary policy. Monetary policy is going to remain very accommodative. And there will be time, I think, in 2-3 years to address inflationary pressures if they will come over time. But I think right now the focus should still be on expansionary policies.
But if you look at what the Fed has been saying, and also in certain parts from the European Central Bank, although the U.S. could reach that inflation target much sooner, when do you think it becomes a problem for central banks? Does inflation need to reach 3.5–4% for them to no longer be able to look through it?
Well, what is key is not so much the statistics. I mean, but the inflation expectations, whether people start getting into their mind that we are going to be at 2% or over inflation in a permanent way. We have seen in the past inflation going back to 2, even going above, but then falling back below 2%. So there needs to be a persistent increase in inflation so that people really think that we are out of the deflationary period that we experienced over the last few years. And this will take time. I don't think that economic agents will change their expectations so rapidly. It will take some time. We've seen long-term rates go up, but still inflation expectations remain really close to 2% or even below 2% in Europe, and it will take some time before this will change.
Where's the next crisis coming from in Europe? Do you worry that actually the U.S. is doing too much, or maybe too much compared to Europe in terms of stimulus, and that Europe is left behind? Or is it retraining because of all the jobs lost because of COVID-19?
When we compare fiscal policy in the U.S. and Europe, we have to be careful because the social system in the U.S. is different from Europe. In Europe, we have what we call automatic stabilizers. That is that, when unemployment increases, then there are some automatic schemes that come to the help of people that lose their jobs directly from the budget. You don't need to adopt new measures. In the US, this welfare system is a bit different, so you need to take action to come in and support the economy. So this is why the US budget looks so huge to support the economy, to support incomes of poor people or people who lost their jobs. But in the end, this is what is needed in the US, given the very important loss of employment and loss of income, which is affecting the economy. So I think this is going to be required, and is going to be there as long as the economy is below full employment. So this will be temporary, and will not affect in a permanent way inflation.
A reminder for all of our viewers, we're at the same time as we're listening to Mr. Binismaghi seeing live pictures of the Italian Senate, where Mario Draghi is delivering his first speech as Italian Prime Minister, saying that the EU needs common budget to combat recessions. He also says vaccinations must be faster, and Italy needs to undertake new reconstruction in true Draghi form. He also said that the government believes the euro is irreversible. Mr. Binismaghi, I don't know whether it brings you back to all those ECB conferences. It certainly brings me back listening to Mario Draghi, although he's speaking at the moment in Italian. Do you worry, and are we underestimating the fact that Europe is becoming more like Japan? And is there anything that the central bank can do to try and avoid that?
Well, we're in for a period of zero rates or even negative rates for some time, because there is excess saving in Europe at the global level. There is need for creation of new assets from the public sector and by the private sector. So you need structural reforms, and this is what Mario Draghi is talking about. the need for Europe to be more competitive, to have initiatives that do not involve only public finances, but also produce an inflow of investments, create new incentives for companies to issue assets, to issue stocks, to recapitalize. And that's why we need in Europe stronger capital markets, especially after Brexit. As you know, there's a lot of things going on in the capital market in Europe, reallocating flows and funds, and this is a way forward for Europe to start depending not only on bank lending but also on capital markets financing for the real economy.
Mr. Binismaghi, thank you so much. Lorenzo Binismaghi, Societe Generale chairman, stays with us, and we'll talk a little bit more about, of course, banking. He has also in the past, Mr. Binismaghi said that the ECB dividend ban last year was making European banks uninvestable. So up next, we continue our conversation with the chairman of Societe Generale, and we'll focus on the banking sector this time. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance. The early edition, I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Rio Tinto is reporting a 20% jump in annual profit, its biggest result in 9 years. It also plans to boost returns to shareholders, paying out a record $9 billion in dividends. The world's top iron ore producer was helped by surging prices for the metal. It continues a strong run of earnings from miners. Now, Nestle has agreed to sell its bottled water business in the US and Canada to private equity firm One Rock. The $4.3 billion deal comes as the food giant continues to revamp its portfolio. Nestle's premium international brands like Perrier and San Pellegrino are not part of the agreement. And car sales in Europe have plunged to a record low for January as the coronavirus continues to hit the continent's biggest markets. Registrations registrations were down over 25%, with Spain seeing a drop of more than 50%. Many manufacturers are having to rely on demand from China. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, European banks have outlined plans to return more than $22 billion to shareholders. That's even after the industry's worst year in decades. Despite its own underperformance, Société Générale has been amongst the most vocal in pushing back against the ECB's decision to cap payouts. Well, we're back with Lorenzo Binismaghi, Société Générale chairman and former ECB policymaker, who's still with us. Mr. Binismaghi, thank you for sticking around. When you look at dividends and buybacks, is 2021 the year where we're back to normal, or are you expecting a stop-and-start situation given where we are with vaccinations and COVID?
Well, the ECB has changed its recommendation banning banks to pay dividends, and this was welcome, and we announced dividends in line with this recommendation. The ECB also indicated that by September of this year we will go back to normality, and so we, for instance, have announced a share buyback program after September. I think that banks have reacted relatively well. They have shown that they are resilient. If you look at the capital ratios of European banks, they have all gone up after the crisis, showing that banks are able to absorb shocks, and they're also able to return capital to shareholders. So I think we are in a situation where we can gradually go back to normality, of course, looking carefully at economic developments and making sure that the companies, the banks, remain solid.
So after 2020, which for Société Générale has been a year of reorganization, cost cuts, is 2021 the year of investment? And if so, where does the bank want to be, to invest in, to grow?
Well, restructuring will continue, of course, in the investment bank and market activities. In the French retail, we are merging our two branches, our two brands, but it's also the start of a development phase in many areas, including in particular our online bank and outside France. So this is, I think, the start of a new era for banking, looking at what we have learned from the crisis, which is, of course, an acceleration of digitalization, of technology, and this will change, I think, the banking environment in Europe.
When do you start worrying about loan loss provisions actually hurting corporate loans?
No, I think we are looking, and the ECB has written to all banks to be very careful, to look at this aspect of credit risk management very carefully, and we are doing this. We haven't seen an increase in the cost of risk that is worrying, but of course we are monitoring because we know that this crisis will take some time before bankruptcies will emerge. There are a lot of guarantees that governments have provided, and so far these guarantees have worked. So I would say we have to be realistic. And we have to be prudent, and we are implementing all the regulations.
Former bankers and SPACs are really the new big thing. Can they sniff at opportunities, growth opportunities, better than the big banks?
Well, maybe they can be an intermediary because ultimately, if you have startups, you have fintechs, we have to see whether these startups can end up on a standalone basis, or they end up being acquired by banks, which ultimately have the data, have the clients, have the confidence, and therefore can be the ultimate host of a fintech development. So if these SPACs help the development of new fintechs, then that can be helpful also for the banking system.
But do they help or do they hinder cross-border consolidation?
No, I don't see at this stage that they can hinder cross-border consolidation to the extent that they can help the development of fintechs, for instance, that simplify and reduce the cost of mergers. This can eventually be helpful.
When you look at, some, I guess, of the blind spots of Société Générale, what will happen to the investment bank to actually possibly take advantage of some of the things that we'll see in the markets in the next 12 to 18 months?
Well, actually, the crisis has shown that those banks that have important investment banking activity have benefited. Of course, we want this part of the business to be stable, to be profitable, not to be too volatile. But in the current environment with low interest rates, revenues which are going to be under pressure in the traditional retail banking, having the opportunity to serve companies, multinational corporations, and being active in the financial markets, this is a plus for a bank like ours. Of course, it has to generate sufficient returns to compensate for the cost and to be stable, and this is what we're working on.
Lorenzo Bini Smaghi, as always, thank you so much for joining us. He is the chairman of Société Générale, joining us on wide-ranging topics today. Now, we're also seeing live pictures of the Italian Senate, where Mario Draghi is delivering his first speech as Italian Prime Minister, saying Italy needs to undertake new reconstruction. He says the EU needs a common budget to combat recession. And of course, the team also alerted me that it's the first time that we hear him talk about policy, foreign policy, saying that actually he's concerned about increasing tensions around China, something that we would not have heard from the former ECB president when he was in charge of the European Central Bank. Now, coming up, finders keepers, a U.S. judge tells Citigroup it will have to do without $500 million it sent to Revlon lenders by mistake. We discuss that with Danny Berger. That's coming up next, and this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition, and I'm Francine Lacqua here in London. Now, Citigroup has lost a legal battle to recover $500 million it sent to Revlon lenders. Last summer, Citi meant to send them an interest payment, but ended up including the principal as well. Now, the judge referred to a 30-year-old legal precedent that essentially says finders keepers. Now, joining us to discuss is Bloomberg's Danny Berger. Danny, okay, I read the story about 5 times last night because I couldn't quite believe it. How surprising is this ruling?
Well, first of all, I feel like it is so strange to talk about finders keepers, not on a playground, but in a legal context. And I think that this is part of what's kind of baffling about this. Even Noah Feldman from Bloomberg Opinion says that if you look at this court case based on just common sense, that the ruling is absurd. But at the end of the day, the facts that the judge basically had to establish, given this precedent, is did the lenders know that this was sent by a mistake at the time that they received it? The judge saying that given that the amount was exactly what they were owed, given that Citi is a sophisticated financial institution that sent nearly $1 billion, that indeed it's reasonable for Revlon lenders to expect this had not been a mistake, again, at the exact moment that they received it, Francine.
Danny, thank you so much. Danny Berger there with a pretty amazing story that you can read more on the Bloomberg website and, of course, on our terminal as well. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lines joins me in New York. Now, we'll talk, of course, about the big freeze and the Arctic temperatures in the U.S. We'll talk about the reflation trade. And, yes, we'll also talk about Italy and Mario Draghi. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. Experimenting, doing something that you always thought you might want to do, trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Time is your friend here.
and leverage is your enemy, and because leverage is uncontrollable.
This is a timely reminder for a wake-up call, really, and saying that, yeah, we absolutely need fossil fuel.
We do not yet see kind of the systemic risk from that asset price inflation.
The Fed can't actually give people jobs.
As long as we're seeing a fully fledged growth recovery, and it's really growth that's driving that reflation, that's absolutely fine.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kaylee Lines.
Live from London, Berlin, and New York, I'm Francine Lacqua with Matt Miller and Kaylee Lines, and these are our top stories today. The big freeze in Texas hits both companies and consumers. Oil production in the Permian Basin slumped by 65% as millions face an extended blackout in the Lone Star State. We look at the global ramifications. Bitcoin breaks out. The digital currency hits a new record above $50,000 and holds on to gains this time around. Is crypto finally getting the backing to go mainstream, or is it just another sign of froth in the markets? And finally, Draghi goes to auction until his new prime minister amasses a record bond sale, and he's talking at the Senate right now. Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. Matt, there's so much going on in the markets. First of all, we look at reflation. We look at what that means for a lot of the asset classes as treasuries are repricing. And then I was looking at a note by Citigroup, outstanding. Mr. Tobias Lekvich saying that actually there could be a 10% correction in U.S. equities.
Yeah, first of all, Tobias Levkovich, one of my favorite strategists. He's actually in the motorcycle gang that I started when I worked down in the New York Stock Exchange. This reflation trade, although it's taking a little bit of a pause, everyone thinks you can keep buying everything but bonds. We're seeing a little bit of a reversal in that trade today. Certainly here in Europe, equity indexes are down and futures are down for the U.S., but there's no reason it would seem to turn it around now. The Fed is still behind everything. Minutes coming out later tonight, and Biden is still pushing hard on his $1.9 trillion stimulus plan. In his town hall, he was touting it yesterday on CNN. So it does look like it's still all systems go, Fran.
A motorcycle gang. I wonder whether it's a WhatsApp group or what. Kaylee, I know you're looking at the freezing temperatures. I think a third of production has been cut off the U.S.
Yeah, it's really dramatic, Francine. A third of oil production, tens of millions of billions of cubic feet of natural gas production taken offline. And the market really is still trying to digest all of this. As Matt said, some of those trains are unwinding just a touch today. But when you look at them over the course of the week, you can see how dramatic they have been. WTI crude up about 2.7%. It is holding above $60 a barrel as a lot of that production capacity has been removed, at least for now, with no real end in sight. You also have natural gas futures up by 5.6% over the course of the last 5 days. I would note that it isn't just all about what's happening in Texas, although that certainly has captured the attention of the market. But with the broader reflation trade, we have really seen a broad commodities rally. Everything from copper to platinum has brought commodity prices higher, and that in turn has brought inflation break-evens higher. Anticipation that higher commodity prices will mean other prices do indeed go higher. As for the energy movers today, not as dramatic of moves as Matt says. The reflation trade not really in full steam today, but you are seeing the energy select sector spider in the pre-market higher by about 0.7%, as are a number of energy players, even those who have had to take some of their production offline in Texas. And I would just note Chevron, a bit of a special case here, up 2.6% in pre-market trading. That has a lot to do with Warren Buffett and Berkshire Hathaway, and I'll have more on that later in the hour. But Matt, what are you keeping an eye on?
Well, I'm looking at the commodities rally as well, and everything looks pretty good. This is a chart going back to 2016, and you can see WTI futures here in blue. In white, we have platinum futures, and that's an important metal to something I'm going to talk about in just a second. See some headlines coming across from Ford here in Europe. In purple, you see lumber futures. In yellow, you see iron futures. And if I'd wanted to, I could have added soft commods and meat prices have been rising. I think 4 months in a row we've seen increases in prices for meat. So, that's adding to the whole reflation trade as well. In terms of platinum, it's important in the use of catalytic converters, and those may not be necessary for much longer. Ford has come out and said, in a story just crossing the ticker. It's going to plow $1 billion into its German assembly plant to start making all-electric cars in just 2 years. This is a big deal because Ford hadn't sold any all-electric cars here in Europe last year. It says by 2030, every car it sells in Europe is going to be all-electric. We're going to talk a little bit later on with Stuart Rowley, Ford of Europe president. Definitely stay tuned for that interview.
Let's go back to yields. Let's go back to U.S. yields actually slipping from a one-year high. And joining us to talk about the reflation trade, to talk about, of course, growth, central banks, and also a possible correction in the U.S. equities is Maya Bhandari, multi-asset portfolio manager at Columbia Threadneedle. Maya, thank you for joining us. I mean, the main story is basically reflation. We've been talking about it for weeks, if not months. Is that going to be a big catalyst for a correction in U.S. equities?
You're right. I mean, I think the reflation trade has been upfront and central and driven those moves in bond yields that you've been speaking of in the show. Now, of course, higher nominal yields generally tends to be relatively good news for equity markets, and particularly when it's driven mainly by break-evens or inflation expectations, as has broadly been the case recently. And we've sort of seen this play through in recent sessions. We've seen some rotation, but broadly positive overall returns. But equally, Francine, valuations are elevated, not atypical at this stage of the recovery, but elevated nonetheless. And companies' cost of finance has rarely looked so good. So although strong earnings does create the room for some de-rating to occur and deliver positive returns, an unpinning of longer-dated yields is a key risk and one that we are watching out for. Now, our base case is for yield.
Ladies and gentlemen, I'm looking to place in order to buy Japanese. So if you want to trade Japanese yen, here is your time. Our indicator tells us that we need to place an order to buy at 105.977. So this is what we are going to do. Just right here. So order placed. So you follow the trades like I said. Place an order and let's get filled. Let's wait until this order will get executed. Okay.
Is realistic. Now, he's not saying that everything is in a bubble, but he's saying 10% correction is not out of the ordinary. Would you agree?
Well, I used to work with Tobias, and I think reading through his research, it is very much linked to what we're seeing coming through on the bond yield side. I mean, you're right. I mean, I think sentiment is quite ebullient. I mean, I was looking at another survey from Merrill Lynch. Cash levels are at 8-year lows, and so sentiment is quite full. However, I mean, I think earnings are coming through really quite nicely. I mean, if we look at the U.S. season, I mean, earnings beats have been amongst the strongest we've seen in recent history. And, for 2020 as a whole, we might end up with earnings down by less than 12%, which is really fairly remarkable in the context of those expectations we had last spring and summer. And so to our minds, the earnings are coming through quite nicely. Estimates are for nearly 24% growth this year. And that does actually allow for some de-rating to occur, but still have those positive total returns. And so we haven't taken off, if you will, our positive stance towards sort of quality growth stocks in the U.S. We continue to favor those, but we hold those increasingly alongside Asian and Japanese equities to capture some of that cyclical momentum and the reflation trade.
I wonder what you expect, Maya, from the yield curve. Abigail Doolittle put together a chart of 2s, 10s versus the S&P 500. And what it shows is when we get a steepening of the yield curve, we tend to get gyrations in the S&P 500, sometimes sell-offs that could even look like a correction. Are you looking at a very steep yield curve at year end?
Well, I mean, the yield curve's already pretty steep, right? So, I mean, the 2-10 yield curve after yesterday's move is, I think, the steepest we've seen since March 2017. I mean, I think it really boils down to, what is driving the move, coming back to what we were speaking of earlier. And I think it really boils down to movements in real yields. And frankly, Matt, it's difficult for us at Columbia Threadneedle to envisage a repeat of the more negative setting of higher real rates like we had, for example, in late 2018 when the Fed was, of course, hiking to get to neutral, or indeed the taper tantrum in 2013, both of which were pretty disruptive for risk. I think we're in a different policy paradigm here. I mean, we've had a real shift in policy making on the fiscal side to go big, to let things run hotter than they otherwise would on the monetary side. And so really much of this comes down to the Fed. And whether the Fed ultimately holds its nerve through late summer and early fall will be key.
Maya, thanks so much. Maya Bandari there of Columbia Threadneedle Multi-Asset Portfolio Manager. And then we also have a great story coming up about no job, or actually no jab, no job. And this is the idea that if you don't get vaccinated, companies in the UK could not give you a job because that would be a legal requirement in your employment contract. Coming up next, we'll talk about the ethics surrounding, of course, these vaccinations. We'll talk about the UK. We'll talk about the reflation trade with Stephen King, HSBC Senior Economic Advisor. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand web.
Okay, traders. Position opened at 105.977 on Japanese yen. Just right here. Long position.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Francine, Matt, I want to take a closer look at the reflation frenzy because while it is unwinding a touch today, it has been quite dramatic since the year started. Bets on more robust fiscal stimulus coming from the U.S., a vaccine rollout leading to better growth is really fueling the cyclically sensitive areas of the market. That is true in small caps. The Russell 2000 up 15% just since the year started relative to just a 4.7% gain for the large cap S&P 500, and it's really true across asset classes. Commodities getting a big lift, the Bloomberg Commodity Index up 9%, and yields moving higher across the curve, but particularly On the longer end, the 10-year Treasury yield up 37 basis points since January 1st, now sitting just shy of a one-year high. And because the selling has really been in duration in the bond market, those longer maturities, we are seeing a dramatic bear steepening. The spread between 5 and 30-year yields now sitting at 150 basis points. This is all leading to higher expectations of inflation as well. U.S. inflation break-evens on a 10-year break-even rate is sitting around 2.25%. But I would note while inflation expectations are high here in the U.S., that is not the case in Europe, where the vaccine rollout has been pretty slow. The odds of a double-dip recession are really quite high, and that has led the spread between German and U.S. 10-year break-even rates to the narrowest, the tightest of all time. So those inflation expectations, the reflation trade, while it is roaring ahead here stateside, that isn't necessarily true across the Atlantic, Francine.
Thank you so much, Kaylee. Inflation is coming. Inflation is coming. To talk about inflation is Stephen King, Senior Economic Advisor at HSBC. Stephen, a million questions about this reflation trade, where it ends up. But actually, given what we're seeing in the U.S. with the stimulus, given what we're seeing in Europe, is it inflation that sticks, that could change the way that central banks do monetary policy? Or is it just inflation that moves bonds and therefore moves markets?
Well, it's clearly moving markets at the moment. Whether it changes central bank policy is another matter altogether. But I guess that if you were to see continuous improvements in growth numbers coming through, perhaps some further increases in input prices in the months ahead, you can imagine some people beginning to think, well, maybe the next move in interest rates is going to be up rather than down. Indeed, in the UK, as one example, 2 or 3 months back, people were talking about negative rates, the need for more stimulus. Now I think markets talk about the possibility of the Bank of England actually raising rates at some point, which of course is reflected in much stronger sterling over the last few weeks. And a lot of it, frankly, has to do with the vaccine programs. That if you're a country with a rapid vaccine rollout and there's a hope that lockdowns can end earlier rather than later, then you have the possibility of significantly higher spending coming through, and that changes basically all of the economic metrics.
But, Stephen, as long as inflation doesn't touch 3.5%, do you believe that the Fed will look through it like they've said they would?
I personally think they might struggle, but it depends in part on what is also going on at the same time. So, for example, if bond yields were to continue rising, then there comes a point when I think the Federal Reserve thinks it may have to do something to effectively respond to those increases in bond prices. If inflation expectations are rising, it may be the case that the central bank has to respond to a certain degree. I mean, I think one of the things that people are forgetting is that we have this enormous fiscal stimulus coming through in the US this year. $1.9 trillion being promised, much of which will come through in 2021. And in normal circumstances, you might think, well, that kind of fiscal stimulus, there's going to be some kind of monetary reaction. What bothers me a little bit is that the markets, in one sense, are sort of hoping for the best of everything. Low rates, more stimulus, faster growth. I'm not sure you can get all of those things simultaneously for a sustained period of time.
So you've been talking a lot over the last couple of weeks about the comparisons, the parallels between the 1920s and the situation that we're in now. I wonder if you can draw any lessons out of the way they dealt with inflation then compared to how we would deal with it now. I mean, I'm assuming our tools are better now, Stephen.
Well, the Fed's got more experience because the Fed was only created in 1913, so they didn't have much experience when they actually got to the 1920s. But I think one thing which is relevant here is that inflation in the 1920s, like the last 10 years or so, was, if anything, too low rather than too high. And certainly in the late 1920s, the Federal Reserve was under pressure, partly from the British, frankly, to keep rates lower for longer, which certainly sat comfortably with the inflation numbers, but it didn't necessarily sit comfortably with what's happening in the equity market. The stock market went from high to ever greater highs in the late 1920s, of course, culminating with the Wall Street crash in October 1929. And you could arguably say that part of the reason why the stock market grew so much was precisely because of this idea of a promise of lower for longer, which, of course, the Federal Reserve eventually had to reverse because it became worried later in that decade about the possibility of an overheating stock market. So if there's a historical parallel, it's really the same idea, really, namely that equity prices have risen a long way, valuations look quite stretched on some measures, and part of that valuation support is coming directly from the idea of lower for longer. Right. If that changes, then of course I think that all bets are off.
Do you think we'll end up seeing a historic parallel with 2013? Is the Fed going to be able to avoid another taper tantrum?
Well, in one sense, what happened in the late 1920s was a bit of a sort of early version of a taper tantrum. I think the Fed desperately wants to avoid that, and I think it obviously is trying to say, look, we need to give the economy some extra slack from a monetary policy point of view. But the biggest challenge that central banks always have is that events overtake them. They don't have a sort of perfect crystal ball to predict what's going to happen in the future. And if it were the case that the economy proves to be different from what they're expecting in terms of their central forecast, either in terms of much faster rebounds in economic activity or possibly a pick up in inflationary pressures, and the promises they've made so far may not come to pass 2 or 3 years down the road, possibly even less time than that.
Stephen, thanks so much. We'll get back to Stephen King of HSBC, and we'll also talk about the possible Japanification of Europe. Now, coming up, Nouriel Roubini, NYU Stern School of Business professor. He's been pretty active and actually not mincing his words on Bitcoin. That interview, 8 a.m. in New York, 1 p.m. in London, and this is Bloomberg.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London with Matt Miller in Berlin and Kaylee Lines in New York. This is your first word news. Utility operators struggling with that deep freeze in Texas have a warning. Those rolling blackouts could keep parts of the state in darkness for days. Now, the power cuts were implemented for a second day in a row to prevent the collapse of electric networks. Outages spread last night to more states, including Arkansas, Louisiana, and Mississippi. Total U.S. oil production has plunged by the most ever because of that unprecedented cold blast, while traders and industry executives say crude output is down by about a third. In America's biggest oil field, the Permian Basin in Texas, production has plummeted by as much as 65%. And the U.S. and Japan reportedly have agreed to extend their agreement on troop funding for a year. According to the Asahi newspaper, the deal will keep Japan's share of the cost of hosting U.S. forces at about $1.9 billion a year. Now, the former President Trump had demanded a fourfold increase in financial support. And finally, another day, another record high for Bitcoin, the world's largest cryptocurrency, rose almost 6% to break the $51,000 level. Bitcoin has risen fivefold in the last year. Activity in Bitcoin futures suggests that traders don't see a sudden end to the crypto rally. Matt has been all over this cryptocurrency story right from the beginning. And when you look at Bitcoin, you keep on arguing, Matt, that it's a store in value.
Yeah, well, I mean, only if you like making money, right? Because you could have bought it any time during its existence and you'd have more money than you did when you purchased it. I mean, we talked about yesterday, you know, if you'd bought it 10 years ago, just $1,000 worth, you'd had $51 million. That's a decent store of value, right? Or do you like it to go the other way?
Until you start losing money. The other thing that we've been looking at, Kaylee, and this goes back to ethics, and I know Stephen King can't wait to get involved in this story, is the FT is reporting that in the UK, companies are thinking about linking employment to COVID jabs. So no jab, no job.
Yeah, the question, I guess, Francine, is where do you draw the line with that? It seems the companies thinking about this are care homes and plumbers, things that require in-person interaction with employees. So I wonder if it's going to kind of stay in those sectors and not anyone who's capable of working from home.
And then we look, of course, at the correction in the markets with Tobias Levkovich saying that he could expect a 10% correction in U.S. equities. The Citigroup chief U.S. equity strategist joins us later today.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kaylee Lyons in New York. We have a lot going on. We talk about Italy with Mario Draghi just giving a speech in the Senate saying he wants further EU integration. And then, Kaylee, one of the things that I'm really interested in is actually what Warren Buffett is doing, and he's selling Apple shares.
He is selling Apple shares, Francine, adding to some other bets as well. This was all revealed in a 13F filing after the bell yesterday, and it's moving some things in the market. One of the things that he's betting on, and this was confidential in the third quarter, granted confidential status, so it was just revealed, is a bet on Verizon. Berkshire had previously bet on this company, then exited it in 2019, but has now reaccumulated an $8.6 billion stake. That stock on that is higher by 4% in pre-market trading. Berkshire also adding a $499 million bet for the insurance broker Marsh & McLennan. Not yet trading in pre-market, though it was up in after-hours trading. And a $2 billion bet on Chevron, which is higher by 2.6%. That, of course, also aided by the energy crisis that is going down in Texas. But as you said, Francine, trimming its stake in Apple. Apple shares are lower by about 0.5% in pre-market trading. Now, granted, it is still Berkshire's biggest single stock holding, worth about $120 billion. But it is interesting that Warren Buffett is trimming his stake in Apple, because when you look across 13F filings, the theme seems to be buy big tech. We can look at what some of the other big names in the space are doing. Bridgewater, Temasek, adding Microsoft, the top new buy. You also saw Tiger Global, D1 Capital adding their stakes in Microsoft. Facebook was a top new buy at Melvin Capital, and even some of the new Airbnbs that are less than a year old, many said were indicative of signs of froth in the market. You are seeing hedge funds getting into those. Airbnb and DoorDash, top new buys at both Tiger and Temasek. Matt, I think it's really interesting. We are seeing the reflation trade. That would mean more cyclicals, less some of these growth stocks, but it seems that hedge funds are still placing their bets here, Matt.
All right, I have been wondering who's buying gold, or who's not buying gold, rather. I've got a chart here. It's 64.39 in the terminal, and it shows the price of Bitcoin in ounces of gold. Bitcoin is now worth almost 30 full ounces of gold, which is insane considering its code that doesn't work that well when the power goes out, as Texas reminded us recently. If you're worried about Armageddon and a zombie apocalypse, I think maybe having gold bars to hand would be much more useful, although it doesn't look like the market believes that. I wonder if maybe it's rates rising that's hurting the price of gold, but for some reason it's not coming along on this trade that looks to be powered by worries of increased debt and never-ending printing. But gold isn't really benefiting, Francine.
Matt, let's look at Italian BDP is also on the move. Italian Prime Minister-designate Mario Draghi laid out his priorities for his new government. Actually, he's been sworn in, so he is Prime Minister once and for all, with the main focus on pro-European views to combat recessions. Now, we earlier spoke to a man that really knows him well because he was working at the ECB at the time of Mario Draghi. He's the Société Générale chair, Lorenzo Binismaghi, and he spoke to us about what he's expecting from Draghi.
If Mario Draghi can make these two changes, spend well and improve the growth potential of Italy, then the public finances problems will be solved by itself, because we will get all out of these high debts only with growth. That's the only way.
So to talk about Italy and possible further European integration, as Mario Draghi laid out in the Italian Senate, is Stephen King from HSBC. Stephen, I mean, I know we used to cover all of the Draghi press conferences, so a lot of people are, he speaks Italian. I can't believe he speaks Italian, but he still thinks the same about Euro and the fact that it's irreversible. Can he really pull it off? Can he get Italy out of the mess they've been in for the last 20 years and integrate Europe?
Well, getting Italy out of its mess alone is a tricky thing, because although Lorenzo Binismaghi is talking about the idea of raising productive potential growth, You need a magic wand normally to do that with any great success. The reality is that Italy's been stuck with a very, very low growth rate for a long period of time. No one has come along yet to try to effectively cure that. And most economists are really not sure themselves as to what you probably would do to make a material difference. So that's the first tricky issue. The second tricky issue, of course, is that when you look across the Atlantic and think about this 1.9 trillion US dollar stimulus package, Europe just can't do the same things. It lacks a European finance ministry, it lacks a European finance minister, it lacks common collection of taxes, it lacks a common bond market. And I think it's fair to say that what Draghi is getting at is that if you want to have a successful monetary policy at the Eurozone level, you need also to have an equivalent successful fiscal policy as well.
Right, but Stephen, what needs to happen for that to be a real possibility? Do you need convergence in terms of their fiscal stance?
Well, you need to have a political agreement that there's going to be burden sharing across different countries. And of course, we don't have that. And of course, there's tremendous resistance to that in various parts of Europe. If you're a rich part of Europe, like, for example, Germany, with bountiful tax revenues coming in a good year, you don't really want to give them away in terms of public spending projects in, say, Italy or Greece. So the kind of federal programs that you might see, let's say, in the US, or within individual countries in Europe are more difficult to apply across countries in Europe. There's still an element of fiscal nationalism at work, which is very different from what happens in the US.
Draghi is saying that the EU needs a common budget at the same time as the EU produces what has to be seen as a colossal failure in terms of prepping to get a virus and then prepping to get a vaccine, I should say, and then acquiring that vaccine. Do you think the problem is they just need more money? If you throw more money at Brussels, will they do a better job at their job?
No, I don't think it's a case of more money. I think it's a case of political structures and political agreement across different countries. I mean, in one sense, the Eurozone is the equivalent of the US if you broke it up into its separate 50 states with one common monetary policy with a series of separate fiscal policies. And you wouldn't really plan for that in the US, and you probably wouldn't think it's a good idea. And effectively, Draghi is saying the same argument in reverse. If you want to have effective fiscal stance in Europe, you need to have something which is closer to what the US already has. And we're a long way away from getting to that point.
So does he want then the United States of Europe? Does he want to push Europe towards the same kind of federal structure that we have in the US?
Well, he gave speeches when he was the president of the European Central Bank, which effectively said that if you want to have a successful euro, you don't need just a kind of monetary single currency arrangement. You need to have some kind of single fiscal arrangement too. So he's given plenty of hints of this. Now, whether he'll call it United States of Europe is another matter altogether. That's quite a pejorative phrase that some people don't like using. But I think there would certainly be a view from him and others who are economically biased to think you need to have something of this kind to make the whole thing work.
Stephen, I just want to bring you some breaking news. Germany just selling 1.23 billion euros worth of 30-year government bonds at an average yield of 0.1%. That is the first time that yield has risen above 0% since March of last year. Yields are on the rise in Germany and really in sovereigns across the world. But when you look at the difference between the U.S. 530s curve, for example, and the German 530s curve, it's the widest gulf in 11 years. When do you see that gap beginning to narrow, or is that divergence only going to grow?
Well, the obvious reason why it's happened is because people have become optimistic about the US, partly through the stimulus program and partly through the vaccination program, both of which are be more effective and more impactful on growth than anything that Germany is currently witnessing. The fact that German yields themselves have risen a bit is a reflection of what's happened globally, that there's a sense that we are seeing a stronger 2021 than we saw at 2020, which is kind of obvious in one sense. And therefore yields are rising a little bit, but 0.1 on yields is still absolutely tiny. I don't think anyone's going to be too worried about the government having to cough up that amount of money to service its debt.
Stephen, are we really becoming like Japan in Europe, and is there anything that anyone can do about it?
Europe's been like Japan for at least 10 years, frankly. If you think about Japan's common sort of features or obvious features, it's low growth, it's low inflation, it's zero interest rates, all those kinds of things. And Europe's had exactly the same thing. And one of the sort of common drivers of that in both areas is demographics, that you have a rapidly aging population in Europe, that in one sense is like Japan 10, 20 years ago. But as you have an aging population, it becomes more risk averse, less growth enthusiastic, less stimulatory in terms of underlying growth. and you end up with some kind of degree of economic stagnation. That's precisely what Japan went through, and it's what Europe is seeing today.
Will we see, though, Stephen, do you think a sizable difference in inequality in European and the U.S. economies due to the vaccination, the slow rollout here and the strong rollout there, or is it, at the end of the day, going to be close enough?
Well, one thing about inequality I think is important to stress is that most of the inequalities we're witnessing at the moment are not actually between countries, they're more within countries, which is one reason why we've had a big increase in populist politics really in recent times. That within the US, you've got some parts that have been absolutely flourishing, like, for example, parts of California or parts of the East Coast, others massively left behind. You can see it's most obviously in house prices. But the same thing also applies to parts of Europe. You know, London has raced ahead in terms of incomes per capita in recent years, whereas, say, Cornwall's been left behind. And in France, Paris has done incredibly well, but other parts of France have done very, very poorly. So actually the inequality issue, I think, predates COVID by many, many years, and is not actually dominated by COVID in the way perhaps you just described.
All right, Stephen, been a pleasure talking to you as always. Stephen King, Senior Economic Advisor at HSBC. Now, coming up, we're going to continue our focus on Europe, but through the lens of an iconic American company. Stuart Rowley, the president of Ford of Europe, joins us as the company announces another $1 billion investment into electric car production here in Germany. This is Bloomberg.
Has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, Francine, Matt, we continue to track the U.S. energy crisis, particularly down in Texas, because millions are still without power. Production is stalled, and there is no real end in sight. This is affecting not just consumers, but companies as well, and really dampening U.S. production of natural gas in particular. U.S. natural gas output yesterday fell to the lowest level since 2018. This chart really really speaks for itself. It's looking at gas output in the lower 48 states that plummeted to just 77.5 billion cubic feet yesterday. That's down about 17% on a year-on-year basis. And when it comes to oil production, that has been cut by about a third. 65% of production in the Permian Basin, which is where the bulk of U.S. production comes from, has been reduced. That is because a lot of individual companies are having to take their production offline, and this is true for refineries as well. Just to take a look at how it impacts a few in particular, both Occidental and Citgo have issued force majeure notices to the people that they are supposed to be delivering their products to. Chevron had to shut in compression and production at their wells in West Texas. Exxon shutting down Beaumont and Baytown refineries, and then Motiva and Marathon both halting their refining operations as well. So companies are getting hit hard by this, even if in theory they could benefit from those higher oil prices stemming from this, Matt.
Yeah, well, that's a problem for now, but someday you won't need those pesky barrels of oil. Joining us from Cologne for an exclusive conversation about electrification is Stuart Rowley, president of Ford Europe. Stuart, great to have you on the program. You are investing now another $1 billion in your plant in Cologne to build electric cars, and by 2030 you want to build only electric cars for sale in Europe. Is that right?
That's correct, Matt. It's a super exciting day for us here in Ford of Europe, and specifically in Cologne. We're announcing that from 2026, all of our passenger vehicles will be zero emission capable, and by 2030 we will sell only battery electric passenger vehicles in Europe. Investing $1 billion here in our Cologne assembly plant to transform it to our own electrification center, and this is where we'll build our first volume battery electric passenger vehicle in Europe from 2023.
All right, we're looking at pictures of the Mach-E rolling down the highway. I'm going to guess that is in California, where you've got a testing center. Stuart, you know, lately we've been seeing the Ford family work more and more with the Porsche Piche people, and you are going to use the Volkswagen platform in this new plant as well. Are you able to cut costs substantially by partnering up with VW?
Well, Matt, we're really pleased with our emerging alliance with Volkswagen. As you point out, we will use the Volkswagen MEV platform for our first domestically produced battery electric vehicle here in Europe. We, of course, have our own Ford electrified platforms. You showed them great Mustang Mach-E built off the Ford platform there. And, of course, we are also partnering with Volkswagen on commercial vehicles where we will lead with Ford platform. So it allows us to get scale, especially in these earlier days of electrification. As you know, scale is really important as we make these vehicles affordable and accessible to our customers. So we're really pleased with the progress of that alliance.
But Stuart, good morning from London. It's no secret Apple is also actively working on a car, a driverless car, probably electric as well. Can you really compete with Apple?
Well, absolutely. Of course, Apple doesn't produce any cars today. We produce many, and of course, we recently announced that we were partnering with Google. You know, the digital experience is going to be more and more important as we move forward as cars electrify, and having a partner like Google will really allow us to differentiate from our.
Stuart, so when are you expecting to actually, you know, sell your first driverless car?
Yeah, we haven't given a date on that, and of course that's led out of our North American business. But we're investing $7 billion in autonomous technology over the next 4 years, and through our Argo AI operation, we're absolutely in the forefront of the race to autonomy.
Well, I want to keep driving my cars, and I'd like one of those to be a new Raptor, maybe a new Bronco as well. Will we see electric platforms for these big off-road vehicles, these big money makers for you?
Yeah, so Matt, I'm not giving details today of the vehicle lines. Of course, we have a Ranger Raptor here in Europe. It's a very successful product, and Ranger is one of our most important commercial vehicles. We had 35% of the compact pickup segment in Europe. Last year grew that to 40% in January. And of course, as we have a a zero emission option in all of our products. That, of course, would include the Ranger.
Stuart, thank you so much. Stuart Rawley, their president of Ford of Europe. Matt, this is why we anchor together. I cannot wait to have a driverless car, just because you can sit back, read a paper, be on TV, and you would not get rid of your car, I guess, until the last moment.
No. I actually still want a V8 under the hood, so I'm waiting for that Raptor you just saw to come out in Raptor R form next year. When it does, then I'll move back, because you can't buy those pickup trucks here.
Yeah, you could actually just drive Kaylee and I around. I'd be up for that. Coming up a little bit later, Rick Perry, former governor of Texas and former energy secretary. We talk, of course, about the Arctic blast and what's happening to LNG and oil prices. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, the early edition. Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Now, my ex-husband on air, Tom Keene, co-anchor of Bloomberg Surveillance, joins us. Tom, I know you're very focused on a lot of the flattening trends, of course, on the German 10-30 years, and then Bitcoin.
Yeah, I am. I'm looking at Bitcoin. Francine, that is something, if you and I went into arbitration, it would be ugly, ugly. I get the dogs. That's all I know. I get vet bill and car
I get everything
card.
else.
You get everything else. You get the wine. What we're going to look at is the wine note is Bitcoin. It is up, up, up. By the time we get talking, it may print 52,000, 51,330. We're going to have an interesting discussion here. Michael McGlone will join us, Francine, was sort of that in-between of Bloomberg Intelligence, but with the leg up here in the incredibly elegant chart. That's log Bitcoin I'm showing there, sort of a fancy chart. Noel Rubini will really push against this. As you know, Francine, Dr. Rubini is not a fan.
I know he's been on a tear, and usually, then it lights up Twitter, Tom. You get hate mail, because we've given a lot of space to him on Bitcoin. I mean, we're seeing also central banks looking at some of these digital currencies, but a lot of them, including the Irish Central Bank, really pushing back against Bitcoin. Yeah,
and Bank of International Settlements as well. I'll talk to Dr. Rubini about Raphael Auer's work there, which I think is just brilliant. Speaking of brilliant, Paul Sankey will join us on oil. Thrilled to have him on, and Michael Gapin on the American economy. There's some real questions here forward with this new high-rate regime.
Tom Keene, thank you so much. Sure. I know you're also looking at what we heard from Citigroup in terms of that possible correction, 10% in terms of U.S. equities, and a very interesting Goldman Sachs note. Anchor there of Bloomberg surveillance coming up in about 5 minutes. Now, let's have a look at what else we're watching today. And Kaylee, very focused on the data.
Very focused on the data, Francine. In just over 2.5 hours, we're going to get producer price inflation data for the month of January. I'm really curious as to whether or not it is going to disappoint like we saw with CPI data last week, and whether the inflation expectations in this market with break-evens around 2.25% maybe have run just a bit too far, too fast. And of course, in addition to PPI, we're also going to get retail sales. So a lot of data dropping in just about 2.5 hours, Francine.
Yeah, Kaylee, I'm watching Italy. Now, this is for two reasons. First of all, we had a bond auction yesterday that went pretty well for Italy, although there was a lot of market chatter afterwards that if you look at, the publicly syndicated debt market, it racked up a new demand for Italy on Tuesday, and then that slowly vanished. We also had a speech by Mario Draghi that was a bit earlier on talking about common issuance and actually wanting to integrate Italy more. So we look at Italian BTPs, but in general, we're just looking at bond yields as they move. What are you watching for, Matt?
I'm watching, I had Abigail Doolittle's chart up earlier showing that when you get these jumps in 2s, 10s, it could be bad for the market. But I spoke yesterday with David Tice, formerly the prudent bear during the financial crisis. He sold that fund to Federated for $1 billion and started producing movies in Hollywood. Tom's talking to Nouriel Roubini today. I've heard lately from David Rosenberg and a lot of talk about Jeremy Grantham. It's beginning to feel like 2008, and I'm worried I'm going to turn the corner and see Nassim Taleb.
Oh, yeah, actually, he's coming up tomorrow, and if he's not, we should book him. Coming up in the next hour, Charles Cantor, Neuberger Berman, Senior Portfolio Manager, Long Short Fund. That's coming up, and of course, we'll work on Nassim Taleb. We'll work on many more newsmakers for Bloomberg Surveillance, the early edition. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
The cyclical elements will almost certainly show some uptick.
You've had an incredible level of churn in this economy.
The point is to unleash consumption.
This is going to be a global recovery if it happens, for the simple reason that it was a global recession.
The hope is that we see this unleashed pent-up demand lift us even higher.
It is inflation that will ultimately drive the shift in monetary and fiscal policy.
We're still in the depths of the crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg Television alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. With equity futures slightly negative on the S&P 500, we spent last week wondering whether we could break 120 on a 10-year, 133 overnight, Tom.
They're right through at 129 right now. John, all sorts of movements in the market, and the conversations today that we're going to have really address these markets. Not only BitDog and Nora Rabini with us. I'm thrilled that Dean Kernett will join us because, John, the one anomaly we've got right now for global Wall Street is a VIX at 21.61. That is not normal.
Looking forward to that conversation a little bit later. Lisa Abramowitz, a German bond auction out a little bit earlier with a yield north of 0%. It tells you about where we've been over the last 12 months.
And it talks about the synchronized increase in yields. You talked about the sell-off overnight. We are seeing bond yields lower in the U.S., but we have seen yields creep higher around the world as people start to price in the unleashing of that consumption.
Do you know what that 30-year was 12 months ago? Tom, 12 months ago? Negative 50-plus basis points on a German 10-year. What a turnaround that's been, Tom.
It's been a turnaround and been, I think, really underreported. There's a great assumption of Europe flat on its back and the vaccination story, John, that you've led on. But this is really of note to see Switzerland long duration and German long duration come up. I think that's been maybe the shock of the first part of this year.
Wednesday morning, is it Wednesday morning?
It's Wednesday morning.
It's Wednesday morning.
John,
let's get you some Wednesday morning price action, Tom. Futures, negative 3 on the S&P 500. I'm going straight through you.
Tom doesn't mean to interrupt.
Straight through you. Never. In a bond market, your 10-year, 128.54. We come down 2 or 3 basis points overnight. 133.10 is your high on a US 10-year. Outside of that, in foreign exchange, euro dollar pulling back to a 120 handle at 120.69. And we inch back just a little bit, Lisa, on S&P 500 futures, down 3 points, off by 1/10%. But the churn, Lisa, in yesterday's session, energy financials, absolutely flying.
Yeah. About the drivers for the S&P. What are they? Because right now I can't find them. Is it fundamentals? We're going to be getting some data coming up in about 2.5 hours. We're going to be getting U.S. January retail sales, which are expected to rebound. Interesting to know that usually you see a lull in January, but last month, it's all mushing together. Are we in 2021? It's Wednesday. Last month we saw a huge disappointment, even though it's typically the holiday sales. We'll also be getting PPI data, producer prices. They are expected to increase, but the fear of a surge in inflation really is not being vindicated in this data. Then at 1 p.m., we'll get a sense of how much demand there is for duration. The U.S. is planning to sell $27 billion of 20-year bonds. I am particularly curious to see the takedown. In other words, who is buying this stuff? Is it international investors? Is it the Federal Reserve, which has accounted for a bulk of the 20-year purchases? And then at 2 p.m., we'll be getting those Fed meeting minutes. Expect them to be mostly a snoozer, but everyone will look inside and try to understand their inflation understanding, what their threshold is to start to think about paring
I think Tom's about
back
to
some of
interrupt
those
John,
bond
does
purchases.
anybody care
That's
about
what I'm
the
going to
Fed
just keep
minutes?
talking.
John,
Yes, there it is.
Does anybody care about the Fed minutes? Seriously?
I think people do today. I think we're trying to work out whether they care about how quickly yields are moving higher. I think the Fed
When
speak
you
later
didn't
this
let
week,
me interrupt
really
your data
important.
check, John, there's only one data check that matters. This morning it is 4 below 0 in Fargo.
Oh, yeah.
That's a data check right now.
Fargo tidbit. And John, this is for you. When it gets to be below 0, your card dies if you do not plug it in. And get this, if you're out there taking notes, if there's a fire and you happen to be a reporter, use a pencil, not a pen, because it freezes.
This sounds like experience.
Just hypothetically. throwing it out there. PSA of the morning, John.
Lisa, thank you. Much more on the deepening energy crisis across the country through this morning. Tom, just to touch on high yield spreads, very interesting to see credit hold in there in yesterday's session. High yield spreads as tight as 315. 315 is a number people in this credit market will remember because that was the tights of early last year going into the pandemic. So we're back to those pre-pandemic tights of early 2020.
John, I can't say this enough how odd the Bloomberg terminal screen is right now. I rarely say that, but the non-correlations out there are fascinating that we can dive into over the next 3 hours.
Totally agree. Let's start it. Let's kick things off with Charles Cantor, shall we? Neuberger Berman Long Short Fund Senior Portfolio Manager. Charles, let's just start here on treasuries. Yields pushing higher, and I think everyone in the equity market asking the same question. When does it start to bite? Not 125, 130. When does it start to bite? How do you frame that for clients? For you yourself, investing, Charles, what's your view?
Thanks. Good morning, Jonathan and Tom. Look, I think at the core of it, higher yields are predicting faster growth. And a little inflation, a little pricing power generally is good for equities. I think the speed of the move matters as much as where rates ultimately settle out. For the last 20 decades, we've lived in a world where rates went in one direction, and that was from the top left to the bottom right. I think, look, 2.5, 2 3/4 becomes somewhat problematic, but to me, that feels like a really long way away.
I look, Charles, where we are, and I see a great adjustment in what corporations will do. You are expert at the dynamics of corporations. What are they doing right now to shape up their income statements, to shape up the need for revenue? Are they activist corporations, or are they gliding into the rest of 2021?
Look, I think corporations are feeling fantastic, having stared into the abyss and worried about the survivability of their businesses and the health of their employees and their supply chains. I think they've survived this rogue wave that almost wiped them out, and now feel emboldened and confident to invest, both inside in their businesses in terms of people and technology and new products and services. And I think they're thinking a lot strategically as well about how do they take advantage of this dramatic rise in their stock prices. On top of that, many of them have shored up their balance sheets by taking advantage of incredibly low yields. As Jonathan mentioned earlier, the yield on high yield, for example, doesn't start with a 5 handle anymore. So there's been shoring up of balance sheets, lots of confidence. And many, I think, are thinking through at what pace they start bringing folks back to the office.
And this definitely has been behind some of the moves that we've seen in equity prices. And certainly it's been helped by a very accommodative Federal Reserve. Is short selling dead in this environment?
No, I don't think short selling is dead at all. I think we're finally in an environment where security selection, stock picking, and risk management matters again. And that played out across all of 2020 and continues to play out in 2021. Yes, there was a moment in January where bad companies went down bad companies went up and good companies went down as everyone tried to bring down gross exposures by covering heavily shorted stocks and funding those purchases by selling down really good companies. But that seems to have worked its way through the system now. Short selling is a massive opportunity to create value, and by understanding where a company's positioned within its sector, within its balance sheet, within its customers, within the global supply chain has never mattered more. And the shorting opportunity is as large today as I've seen it in my career.
How nervous do you feel about being short? How comfortable are you, Charles? Surely over the last 3 months, you feel a little bit more nervous putting that trade on.
Look, it's all about how you position the shorts, and it's all about understanding where others are within regard to betting against a company. We manage our short positions very cautiously. We're fully aware of levels of short interest, but we're not betting that a company goes away, and we're not betting our business that company goes away. And when you combine those two things, I think you sleep pretty well at night.
The shorting opportunity is the biggest in my career. I mean, Charles, you have got to put some numbers on that. Where? In energy, we've seen a gain of almost 20% year to date. You've seen a similar move in small caps on a Russell as well. Where are you seeing these massive opportunities?
Look, we see a market that continues to be very bifurcated between value and growth and different sectors and how companies are positioned. Our sense is those companies that are still behind in terms of digitizing their business, taking their businesses to the cloud, engaging in their customers in a very different way, are going to find it very difficult. There are a bunch of companies out there whose stories are so fanciful they can't be validated nor refuted. And those are the companies that I prefer not to mention, but those are the companies where over time, truth will get revealed. And if you can manage those positions within cautiously and small, I think at some point you get paid.
Charles Cantor, give a lesson to all of Global Wall Street watching this morning. How much short interest is too much short interest? I mean, GameStop was out well over 100%. You got to be nuts to go against that. Do you have a limit in your head where you say if it's 30% short interest, that the 30% of the shares out, I'm betting against it, they're going to go down? Is that too much? Do you have a number?
I think you've got to think about short interest and position sizing together. So the larger the short interest, the smaller the position should be for us within the context of what is reasonable. I think once you get north of 20% short, beware. But that doesn't mean you don't short that company. But once you get north of 20%, I think as a rule of thumb, you want to start thinking critically about how crowded you are. But then you want to think about your position within the context of the entire short interest. How much of the short interest is you versus someone else? I mean, part of the challenge is, so many folks are on the same side of the trade at the same time, and then they'll all do the same thing at exactly the same time. I always found it curious that the retail investor got accused of groupthink, but the institutional short seller was also part of the groupthink because they were all in it at the same time and then all do exactly the same thing to manage down their gross exposures at the same time, which creates this enormous opportunity to make money.
Charles, I can't believe you ran down the clock without actually telling us where to find these shorts.
He said he didn't want to comment. He said the companies are so fanciful, the stories, you couldn't be confirmed or denied.
Can you just give us a description?
Okay.
Does it rhyme with Wesla?
Charles, is Tesla on your list?
Tesla, it may not, but it's where the businesses are pursuing a total addressable market that seems massive. Valuations are fanciful. Revenue doesn't seem to be very great today, but enormous 5 years from now. There are a lot of those businesses out there. And that piece of the market, candidly, feels very 1999.
I mean,
the rest of the market doesn't feel 99 at all.
We need a private conversation, Charles. Let's catch up. Charles Cantor, Neuberger Berman, Long Short Fund Senior Portfolio Manager. You'll catch me tomorrow on Bloomberg TV talking about a source of mine who told me about a company, but he's very short right now.
With fanciful business models.
That was an absolute clinic, and to frame that, given GameStop, American Airlines was 22% short interest.
Yeah. Coming up on the program at 7 Eastern, Dean Kernett, Macro Risk Advisor, CEO from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Utility operators struggling with that deep freeze in Texas have a warning. Those rolling blackouts could keep parts of the state in darkness for days. Power cuts were implemented for a second day in a row to prevent the collapse of electric networks. Outages spread last night to more states, including Arkansas, Louisiana, and Mississippi. Meanwhile, total U.S. oil production has plunged by the most ever because of that unprecedented coal blast. Traders and industry executives say crude output is down by about a third. In America's biggest oil field, the Permian Basin in Texas, production has plummeted by as much as 65%. And another day, another record high for Bitcoin. The world's largest cryptocurrency rose almost 6% to break the 51,000 level. Bitcoin has risen fivefold in the last year. Activity in Bitcoin futures suggests traders don't see a sudden end to the crypto rally. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I do hear up to this point that about 400,000 households power will be restored sometime today. But in view of the fact that there are 1.3 million customers that are without power in this Houston region, the Centerpoint territory, that means we still have a way to go.
That was Sylvester Turner, the mayor of Houston, weighing in on the energy crisis developing across the country and gripping the state of Texas. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. 6:18 Eastern, counting you down to the opening bell. Here's the price action. Equity futures down 3, off by 0.1% on the S&P 500. Yesterday, almost exactly what Morgan Stanley and the team are looking for. Year-end price target 3,900, but huge churn beneath, and that's what you saw in yesterday's session. Energy, financials, flying. The why? Well, Cruise got a 64 handle on Brent, $64.09, up another 1%, and yields were pushing higher over the last couple of weeks. We broke 130 and then some in the last 24 hours. Right now, we pull back by 2 basis points to 128. 88. Tom, that's the price action. If that didn't get your attention, maybe this will. A letter from the former President Donald Trump. I say a letter, a statement, but you know who that letter would be addressed to if it was a letter. Dear Mitch McConnell. He went on to say the following to the senator. He described him as a dour, sullen, and unsmiling political hack.
I mean, there it is, and it's gone from a tweet to 600 words, which I guess is a form of communication. We've got lots to talk to Kevin Cirilli about. He is our dour, sullen, and unsmiling television hack in Washington, and we're thrilled he could join us today. Kevin, this is fascinating. You have followed President Trump from the earliest of early days. If he's not on Twitter, how would you suggest he will communicate to his base?
Well, it's a long-form anti-Valentine Day message from the former president. And I mentioned this yesterday, but it bears repeating. I think when you're staring down the beginning of a potential California recall on the West Coast in just a couple of weeks, and this California recall really does provide an opportunity for a trial balloon of sorts to see just how far the Trump political movement could go in, you know, and again, that data that the Trump political movement needs to reassess ahead of the midterms and the next cycle.
Brief us on the recall in California, because I'm going to assume our global Wall Street audience isn't that familiar with the trials of Governor Newsom.
Well, look, there's a couple of weeks left in mid-March that the folks have in order to gather enough signatures for there to be a recall against the Democratic governor of America's largest state. And, you know, I mean, from a Bloomberg political audience, or from a Bloomberg policy audience, look no further than U.S.-China relations on the technological front, i.e. San Francisco. Look no further than as it relates to energy policy. And we all remember the administration, the former administration, battling California as it relates to energy policy in the auto sector and various emission standards. And of course, there are Republicans in California, in Orange County, a new type of Republican, but there are Republicans in California, and you go further inland, and that's where some of the folks like Rick Grinnell, the former acting director of national intelligence, are floating trial balloons to see if they might be able to win. Remember when Arnold Schwarzenegger was governor of California? He was a Republican.
Well, let's move away from the politics into what's actually getting done in Washington, D.C. We had been talking about a fiscal stimulus bill. Is it a fiscal relief bill? Is it stimulus? We'll find out. Meanwhile, at 3:30 today, President Biden, Kamala Harris, Vice President, are going to be talking with a number of different labor leaders about the American Rescue Plan, infrastructure spending. What's actually getting done, and what can we actually see in the next couple of weeks?
Lisa, yesterday I spoke with former Energy Secretary Dan Brulette on Bloomberg Sound On, and I asked him point blank, as a Republican, whether or not he is going to be able to get on board with infrastructure as a result of the crisis in Texas. He said that infrastructure was definitely needed. Now, where he backed off was not not putting a price tag on that package. But Lisa, there is an appetite in wake of Texas for there to be an open conversation about bolstering infrastructure. But look, we're still a couple of weeks away from the stimulus, and I do talk to Republicans who are very wary of spending additional money right now.
Where does climate change sit in that conversation now, Kevin?
You know, I remember back a couple of years ago when certain Republicans tried to push back against how climate change has been framed in this political climate in Washington, D.C. There are some Republicans who would argue that the climate change is real, but the private sector ought to be the ones that innovate out of this. You know, in terms of where the Texas debacle fits into the climate change conversation is again, and I said it yesterday, but I spoke with some of their staffs after Bloomberg surveillance yesterday, of those four centrist Democrats who are urging the Biden administration to back off some of their rescinding of Trump-era energy policies. The Energy Committee chairman, the new Energy Committee chairman, Joe Manchin of West Virginia, is definitely going to have a fascinating political referee to officiate over that committee.
The reason I asked this, Kevin, because I think it's really interesting to see how politicians respond to an energy crisis in California and one playing out in Texas. Is it divided by political lines, party lines, or is there some kind of coherent strategy coming together here?
Well, look, I think that America in the last 24 hours and over the next couple of days is really going to start to understand just how influential Texas is in providing energy, not just to the mainland, but also to Mexico. And as a result of that, there are a massive crises that we're all watching, unfortunately, unfold. But Texas' influence in the energy world is now in full vision.
Kevin, great to catch up. Drop by in the next hour, hopefully. Kevin Cerretti, Chief Washington Correspondent and host of Sound On, of course, on Bloomberg Radio. You will notice the energy difference at 6:24 and 7:24 with Kevin. Once the caffeine, Lisa, kicks in, he is a different man.
Yeah, especially if Tom keeps telling him that he looks sour and dour and whatever else. I mean, he'll be a different person.
That'll bring him back.
That's fantastic. That'll be fighting words,
get him
Tom.
back here.
We're doing shameless plugs here, folks. We are all excited to tell you that the real yield is expanded out to a Cineramic 30 minutes.
Okay.
30 minutes this Friday, 1 p.m. Look for Bloomberg Real Yield with John Farrow, expanded edition this Friday.
You can tell I'm not happy with you about something, and that's why you've done this. That's impressive, Tom. Thank you.
It's very good.
Thank you.
There's a rally for an hour show, but I don't know where that
This is
stands.
basically you acknowledging that you've been misbehaving the last couple of days, but I appreciate it.
Got that right.
Do you guys want to work something out?
We do, but
Okay,
maybe
carry
not
on.
right here, right now. Back to its original length. Looking forward to doing that. It's been a while. 25 minutes long. 1 p.m. Eastern time. Looking forward to you doing the warm-up act again, Tom, on Friday. You're going to do that? A nice little lead-in?
Yeah, we'll do something like that. I'm looking at the 10-year yield. The real yield, John, has come in here nicely, negative 0.96.
Yeah.
No, negative 0.96, John. Seriously, it's come in real nicely. That's a change from
in a couple of basis points. And I'd have to say that there was some suggestion that maybe we'd start to see it move the other way. But still, Tom, negative 96 basis points.
Doesn't get it done. Absolutely.
That is a low real yield. Looking at the broader market, your nominal yield, 129 on a 10-year, up by 10, 11 basis points in yesterday's session? Just unreal. Today, down by 2 basis points. We come in just a little bit. Outside of that, in foreign exchange, euro dollar back to 120.64. Bit of dollar strength there. And in the equity market, just a really big churn beneath the surface that we need to pay attention to. Down 3 points on the S&P, negative 0.1%. This is Bloomberg.
feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast.
and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance live on Bloomberg Television for our audience worldwide. 6:30 Eastern, here's the price action. I'll try and keep this short and snappy. Just a quick one. S&P 500 futures coming in about 1/10%. Yesterday, a lot of churn. Energy financials doing really quite nicely. The index, though, not doing a lot at all. Switch up the board and get to this. 2s, 10s, 30s. The bond market getting all the attention in the last couple of weeks, in the last 24 hours specifically. Your 10-year yield overnight, an icebreaker 130. We come back to 129, down about 2 basis points. Your 30-year through 2% last Monday. We add to that in the last day or so. 2.0651% on a 30-year. Here's the thing for the Fed. Some Fed speak through the week. You hear from Chairman Powell next week as well. We keep going back to the same theme. Can yields go higher and financial conditions stay loose? Finish on this one. Bloomberg Financial Conditions Index. That number right there is positive. This is important. This is about the cost, the availability of credit. You get the picture here. Guess where the pandemic was? You can see it right there. Financial conditions tighten. The Fed steps in. They stay loose. Look at the far side, Tom. That's the hint right there. Even as yields push higher, conditions have stayed loose.
I'm really glad you put that out. Michael Rosenberg's brilliant research for Bloomberg. That's an adult index, folks, and that's a good sign of where we are. One final data check idea. Heat wave in Fargo. They're up to 3 below zero, so we're moving forward through the morning. Right now on oil, definitive is Paul Sankey. Long ago and far away at Deutsche Bank, there was absolute definitive sell-side research, like a Bible. You read Szymanski and Sankey on the global supply, the global demand of oil. We're thrilled that Paul Sankey could join us from Sankey Research this morning. Paul, with the gyrations that we see in the Midwest of the United States, in Texas, Permian Basin, et cetera, can we get out of the assumption of range-bound oil?
Well, look, these are not gyrations. I mean, this situation to me is very reminiscent of Hurricane Katrina, where, if you recall, on the Monday after Katrina, there was sort of an attitude that this hasn't been that big a deal. And then over the course of the following week, it suddenly, emerged as a horrendous disaster. So gyrations, and this I've observed this morning, Tom, people don't realize how bad the situation is. I mean, you've got, like, as you mentioned, your previous guest mentioned, you've got basically full-scale blackouts in Mexico. But you've also lost here the biggest outage in the history of U.S. oil and gas. I mean, this thing is, we have never seen a loss of this scale at a time when, you're in midwinter. So basically, we think you've lost about 3 million barrels a day of oil. We think you've lost about 10 BCF of gas at least. And we're down at least 3 million barrels a day in refining. All of these, for example, in refining, at the base of about 16 million barrels a day, with inventories not that high. So this is an energy crisis. And, gyrations, you're seeing Brent at 64 here. The obvious price reaction would be, firstly, obviously, if you lose U.S. Texas oil, you'd be expecting Brent to go up, and it is. And
what is your price target? I mean, give us visibility on price right now.
Well, we've been talking a lot about the dollar. So we think you can get to 80 this year based on the dollar. Now, that obviously, if the dollar strengthens a lot, that calls a dud. But essentially, oil should be around 65, 70 just on the dollar, at 90 on the DXY. If we break down to 80, in below, then you could easily see oil at 80. And therefore there's quite a bit of upside at this point, that was prior to this outage. So, we'll see how this thing plays out. But I think it's going to take a long time to sort this problem out.
Well, Paul, can you talk about the way forward? In other words, how much federal interference has to be waged here, given the fact that to upgrade Texas's infrastructure to be more weatherproof would cost trillions of dollars, and we're looking at a state that doesn't insure against potential outages the way that places in the Northeast do. How do you see the federal government getting involved?
Well, so far, the only comment's been from AOC. We haven't really seen much from the president, for example. I know he's following a post-Trump, no Twitter kind of approach. But, it's a major problem for the Texans, and they're going to have to completely rethink. This is really existential in terms of how much wind and how much solar you can have in a system, given that, you were caught really badly short. What happens if you lose natural gas? And, to be honest, people hadn't really thought, what happens if there's a major nat gas outage at a time when there's no wind and solar? And the answer probably is, well, where are your nukes? Or where's your coal fire?
Well, hold on a second, Paul. But this is really important because yesterday we had a Texas regulator come on and say that the fault really